I found it. I found the Internal Revenue Code section. In this video, we're going to be looking at what I call tax scavenger hunts. We're going to be actually going through some scenarios and navigating the Internal Revenue Code. Navigation of the Internal Revenue Code is very, very important to becoming a tax practitioner. Again, the Internal Revenue Code is by far the most important of all the different types of tax authorities. So with that, it's going to be important that we actually learn how to navigate it. We're going to start by looking at the table of contents and getting an idea there of the different topics. Now, we're going to be focusing on income tax. So just income tax. So we're not going to look at the estate tax procedural areas of the Internal Revenue Code, but of course, that's very important. Also in this video, just understand that I am filming this at a time where things may change. So this is meant to be helpful and provide you with the way to learn how to learn. The structure will be very much the same when you're watching the video, but there may be some sections that are out of sync or out of order. So again, do not rely on the code I'm providing you 100%, but you can use these different tools that you're learning from this video, right? You can go through and actually use the way that we're searching the code and those strategies. All right, let's go ahead and jump into it. Before we go through some scenarios, some scavenger hunt scenarios, I want to look at a few things looking at the Internal Revenue Code, the table of contents, and a few code sections. There are a few tax themes that I really want to drive home that will help you when you're navigating the Internal Revenue Code. Now, before we look at that, I want to mention I have a few other videos that will help you. So first thing, I have a top 100 tax code sections video. Make sure you watch that video before this one. That video goes over the table of contents of the Internal Revenue Code, and it also mentions 100 code sections that are very, very important. And understanding those 100 code sections in that video will give you an idea of some of the more important areas of the tax law, as well as it shows the structure, which is what we're going to be focusing on a lot when we're looking at these scenarios. Another video deals with helpful tax themes to help master tax law. So there's a tax theme video I have, and some of those tax themes that we're going to go through will be in this video as well. I like to kind of integrate all of those. But really, there's 3 videos that kind of work together. This video, which is on the tax scavenger hunts of the Internal Revenue Code, the top 100 tax code sections, and the tax themes. Okay. Let's go ahead. We're going to look at the Internal Revenue Code now, starting with the table of contents. There's a few things I'm going to mention. Now, if you're taking my tax research class, this is just for those out there not taking my tax research class, you can kind of ignore this. But if you're taking my tax research class, what I have is I have an Internal Revenue Code that you're going to use for the scavenger hunts. And this table of contents, and you'll see a page number at the bottom, it actually refers to that. So we're actually going to be looking at code sections later on, and you're going to see on the bottom right-hand corner the page numbers. Now, if you are in my tax research class, I provide you that Internal Revenue Code, that IRC, that you actually going to use on your exam, that part of the exam where you're allowed to actually navigate the Internal Revenue Code to answer some scenarios, some fact patterns where I want you to maybe locate a code section or a subsection of a code section or a paragraph or subparagraph or clause or an exception or, and provide the reference. Because navigating the Internal Revenue Code is very, very important for tax research. Now, when you get that Internal Revenue Code, you may be able to use the features like, Control F and finding it, finding words and whatnot. On the exam, the version I have, you're not going to be able to do that, okay? Trust me. I was a student not too long ago. I'm a continually a student. I understand technology. The version that I'm going to provide, you're not going to be able to search. However, it's again going to be the same file, so understanding the page numbers is really important, okay? And I actually, on the table of contents, you're going to see after the first page that I broke down the page numbers down by the subchapter, by the part, the subpart, obviously not by the section because that would be a little bit too much, but I broke down the page numbers so if you're looking for those things. So really, when you're doing tax research in my class, and for those of you not in my class, the starting point should always be with the Internal Revenue Code, and the table of contents is very, very helpful. Now, another thing I want to highlight, the Internal Revenue Code here, and again, this is the one that I'm using for my class. For those people out there, this Internal Revenue Code, it may or may not have things, it may have things in the future are different, or code sections might not be there that maybe were added later on. This is meant to be a tool for learning. The idea is that I'm teaching you how to learn how to learn. I'm teaching you the steps in learning tax research. It's not meant to be in any way substantive knowledge, although when we do the fact pattern, we have to obviously figure out where to locate. So it's meant for that. So do not rely on this this code. Do not rely on this code for any tax advice. Do not rely for tax advice. However, you can rely on this video for tax research steps, for navigating the Internal Revenue Code, because the structure stays the same. It stays the same, okay? So keep that in mind for those of you watching in the future. So this Internal Revenue Code, it's obviously Title 26. We're focusing, though, on Subtitle A, income taxes, so only income taxation, and specifically just Chapter 1, which is the normal income taxes and surtaxes, so sections 1 through 1400Z-2. Now, here are the subchapters. Here are the subchapters, and I have them labeled out, and they provide the specific items. Now, again, in my Top 100 Tax Code section video, I go through all these different subchapters. Okay, I go through everything. I go through the entire table of contents, and I talk about various tax themes. I'm going to be talking about some of those tax themes as well, but I want to do that, the tax themes, talk about those by actually looking at the code sections here. We're actually going to pull up some various code sections, and I'll show you those, okay? And by the way, here again is the caveat. You should not rely on this Internal Revenue Code to make any tax decisions, okay? So let's continue on. All right, so I'm going to change the color of the highlighting to green. We're going to go down. We're going to skip subchapter A because there's no code section specifically I want to talk about. Again, you can watch the Top 100 Tax Code section video, and I go through the table of contents, and I talk about that subchapter. We're going to go to subchapter B. Subchapter B, let's pull up that entire subchapter on the screen. So we're in subchapter B. Again, look at the page numbers. And by the way, again, if you're taking my class, remember, this document will be the same on the exam when you're on that part of the exam where you're allowed to use the code, and you can kind of learn the pages. You also have the pages listed here. So subchapter B, for example, look, page 537. So if we skip to 537 in that document, scrolling down, can get around 537, you will be in subchapter B. You can kind of get an idea. Again, I also have the parts. So part 1 you find is page 537. We're going to look at section 61. Okay, we're going to go through section 61. We're going to talk more about why later on, but that's one of the code sections that we're going to highlight on, okay? And then we're going to go to section 72, annuities and other items. Then we're going to talk about section 74, prizes and awards. Okay, prizes and awards. Again, the Top 100 Tax Code section video, we actually went through a lot of these items together in the table of contents. So we're not talking about those things again. Please watch that. But we are going to look at some actual code sections because there are some things I want to stress, some themes. Then we're going to go down to part 3, section 101. We're going to look there. We're also going to look at section 111, recovery of tax benefit items. All right. And then we're going to continue on down to part 6. Itemized deductions for individuals and corporations. We're going to take a look at section 161 and 162. We're going to look at section 165. All right. Then we are going to continue on down the path. And we are going to then go down here to part 9. We're going to be looking at sections 261, 262, and 263. So look at those. We're also going to look at section 265. Another item in part 9 that we're going to look at is section 274. So we're going to look at section 274. So let's make sure we highlight that. Keep these in mind. We'll be looking at these code sections specifically. We're actually going to read the language of the code sections. This, of the 3 videos we've done so far, this is the first time we'll be doing this. Okay, we'll be actually reading the code sections. Okay, then we're going to continue on, and we're going to go all the way. We're going to skip a lot of items, so let's go all the way down. We're going to skip down to our property transactions. Okay, skip down to our property transactions down in subchapter O, right, section 1001. So going on down real far, right? Skipping a lot of stuff. Again, top 100 tax code section video. We go through all these areas, and I talk about all those and bring up some items. So please watch that. We're going to look at section 1001 in subchapter O. Determination of amounts of and recognition of gain or loss. We're also going to look at section 1031. Exchange of real property held for productive use or investment, also known as like-kind exchange rule. Then we're going to go down to subchapter P, specifically sections 1221 and 1231. Finally, we're going to finish off our discussion talking about a code section that is not actually in the income tax area. We're going to look at section 7701. Now, the reason I'm talking about section 7701 is because of tax themes. It's the general definition area of the tax code, and it applies the entire code. Just so you know, on the exam for those students that are taking me for the tax research class, I'm not going to give you a problem that deals with section 7701 because 7701 is not found in your code. So keep that in mind. Again, the questions only come from the income tax area because you're only given the income tax area of the Internal Revenue Code. So keep that in mind. All right, so let's go to our first code section, section 61. Okay, so we have the language for code section 61. Let's get some highlighting. Now, when you're looking through the Internal Revenue Code, the one I provide, what you're going to see is it provides section 61 gross income defined, the title, and then it actually has it again second. I want to make it bold so you can see that. So this bold lettering, that's when you know a new code section is there, okay? Now, remember the pages are very important. So if you look at that table of contents, you'll see section 61 is on page 537. As you can see, page 537. Now, one thing I want to stress, again, is please watch that top 100 tax code section video because it goes through the structure of the Internal Revenue Code and a lot of the tax themes. Many of those we're going to talk about now. But one thing that I don't talk about in this video, I talk about in that, is the structure of the table of contents, right? Looking at the title to subtitle, chapter to subchapter, part to subpart, and then section, okay? Now we're going to be diving into actually reading code sections so we can look at section, which is here is section 61, subsection, which is section A, right? You see that here? Then we can go down to paragraph, subparagraph, and then, and so on. And as you can see here, we just have paragraphs. We don't have subparagraphs. We'll be doing that later on in other code sections. So not every code section will have that, as I've mentioned in previous videos. Okay, this is section 61, gross income defined. So general definition. We start off with general definition. That's the title. Except as otherwise provided in this subtitle. So right there, we're going to stop. That is very important language. One of the most important tax themes, okay? So if I highlight something, it's very important when it comes to tax themes. But one important tax theme deals with, when you're reading the Internal Revenue Code, you have to look for these references to the level. So references to the level. And the reason why is because you're going to find definitions and whatnot in a code section that specifically refer to subtitle, title, section, subsection, part, subpart. You're going to see all these different references. Now, when we go through in these videos, I will make sure to highlight those things. But always keep that in mind because here it says subtitle. So that means this is the subtitle dealing with income tax. But if you're talking about employment taxes or estate and gift tax, that means that this definition of gross income does not apply there. So it's very important to understand what level you're dealing with. And you'll find these references in the actual code section. And it says, gross income means all income from whatever source derived, and then including but not limited to the following items, and it gives a list of items. Okay? So remember that every code section has a tax treatment rule. Here, and you usually find it towards the top. And notice it says general definition, and it actually provides that. So the way the code section usually is set up is the beginning, the general rule. Then you'll have exceptions to the exceptions below that. Exceptions to the general rule below the general rule, and then you'll have exceptions to the exceptions, if any, if you're going down. So not every code section will have an exception. It will have a general rule, though, which is a tax treatment rule. So the tax treatment rule, the TTR, Well, we're dealing with income, and if you recall, the two verbiages or two words we use for the verbiage for income is include and exclude. So this is include. It says including. So gross income means all income from whatever source derived, include. So what we're saying here, we include income and gross income. Okay, we include income, gross income. Yes, I know you're like, well, that's ridiculous. We're defining a definition by definition. That's how Congress did this. They kept it broad. Speaking of broad, remember one of the tax themes is that gross income or income, put GI for gross income. Gross income is to be defined broadly and deductions to be defined narrowly. So this was set in the Supreme Court jurisprudence, the case law, that, okay, when the Supreme Court or when the courts interpret the tax law, the Internal Revenue Code, income or gross income is to be defined broadly, deductions to be defined narrowly. A very important case called New Colonial Ice, but there's other ones as well that people reference, Supreme Court case where the court ruled that way, okay? So keep that in mind. It goes to that whole broad idea, and that's a tax theme because if you are questioning whether something is income or it's not income, it's better to think of it broadly, which means that if you're questioning it, it probably is income. Because again, Congress is using the broadest language possible, right? Income, gross income means all income from whatever source derived, just like the 16th Amendment. It goes all the way to the broadest protection allowed under the amendment, the 16th Amendment to the Constitution. But deductions define narrowly. So when we talk about deductions later, if there's an interpretation issue, you should err on the side of not allowing the deduction, okay? The last thing I want to mention is the structure of gross income. So we learned in the top 100 tax code section video, looking at the table of contents, remember it's a checklist approach. If you have an inflow, if you're dealing with an inflow, a taxpayer has an inflow. So the question is whether something is income. You start by asking, is it gross income under Section 61? Now, this is very broad. It doesn't really provide much detail. We talked about the case Glenshaw Glass, GG. Glenshaw Glass, remember, there's 3 requirements, and if you have all 3 requirements, you have gross income. Accession to wealth, realization, or severance, and dominion and control. If you have all 3 of these items, you have gross income. Now, again, if you want more talk about this, please see the top 100 tax code section video. So let's say we have all 3. If you have all 3, so if you do not have gross income under this test, under Glenshaw Glass or these items, then you stop. It's not actually recorded on the tax return. But if you do have it, yes, then there's one more step. And that is to go to part 3 of subchapter B and ask, are there any exclusions? Okay, and if there are exclusions, if yes, then it does not go on the tax return. But if no, then it does go on the tax return. That's how we do this. Now, one thing to note is that in defining gross income, there's part 2 of subchapter B, which provides special rules. And we're going to look at that when we look at section 72. I'm going to go through that together. Finally, the last thing I want to do before we continue on and move to the next code section, let's just read through this code section. So remember, we read the beginning. We saw the tax treatment rule. Except as otherwise provided in the subtitle, gross income means all income from whatever source derived, including but not limited to the following items. So we have 1, compensation for services, blah, blah, blah. 2, gross income derived from business. 3, gains derived from dealings in property. 4, interest. 5, rents. 6, royalties. 7, dividends. 8, annuities. 9, income from life insurance and endowments. 10, pensions. 11, income from discharge of indebtedness. 12, distributive share of partnership gross income. 13, income in respect of a decedent. And 14, income from an interest in an estate or trust. And then there's a cross-reference, which is subsection B. For items specifically included in gross income, see part 2, as I mentioned. Okay, so we go there. For items specifically excluded from gross income, see part 3. So this right here is where I'm telling you that checklist is set. So Congress actually says, hey, yes, you start here, section 61, and you do the no and the yes. If you do have section 61 gross income, Then you go on to part 3, right? If there's any exclusions. Are there any exclusions? If there's an exclusion, then it's not recorded in the tax return. But if there's no exclusion, it is reported on tax return. So again, if there's no exclusion, it's reported. If there is an exclusion, it's not reported on tax return. Now, in defining what gross income is, part 2 provides some special rules. We're going to take a look at that in a moment. Part 3 provides the exclusions. It says specifically to look there. So when you're doing tax research, if you come across an issue that deals with, hey, is something gross income? We'll see this later in some of the scenarios. You start by looking at section 61 always. You determine, hey, is it gross income? Then you look at part 2 as well to determine if there's special rules. Okay, so if you have like an annuity or group term life insurance, there's special rules that apply to those items. And then if you determine, hey, something is gross income under that test, then you go on to the exclusions. And you look in part 3 and say, are there any specific exclusions? If there's not, it's included in the tax return. But if there is an exclusion, it's not included in the tax return. It's not reported. Now, one thing else I want to note is notice this list. It provides these 14 items, right? These 14 items. These are examples. The tax law does this. I'm going to show you 2 examples of this, but it does it throughout the tax law. This is one example. Notice it says gross income means all income from whatever source derived, keeping it broad, including but not limited to. You know what that means? Take that language on its face. That means, hey, we're providing 14 examples. Congress gives you 14 examples, but these are not an exhaustive list. So it's not just these 14 things. It could be other things on here that are not on here, like mining cryptocurrency. If you mine cryptocurrency, which if you're not sure what that is, go ahead and stop the video and search that online. But mining cryptocurrency is considered gross income. Not on that list, but notice the list has items that we normally think. There might be special items like mining cryptocurrency that the IRS or courts or whatnot have ruled is considered gross income. Okay, so keep that in mind, that this list is not exhaustive. It's not an exhaustive list. Keep that in mind. Okay, let's go on now to the part 2 items. Specifically, let's look at section 72. So we have section 72. And this is a longer code section. So in this one, we're going to be taking a look at the structure of the actual code so I can show you, if you're citing down to something, how you cite down to it, just to give you some examples. Also, we're going to obviously take a look at these different things, at these different items, including some of the items that I mentioned before. So we're going to start off under section 72, annuity, certain proceeds of endowment and life insurance contracts. A, general rule for annuity. So remember, every code section has a tax treatment rule. So we usually start off there. Not always, but usually. So the tax treatment rule, the TTR, let's see. Income inclusion. So it's going to be an inclusion rule. We include. And specifically the language says, except as otherwise provided in this chapter. Right? Remember we saw in the last one, it was except as otherwise provided in this subtitle. Now it's chapter, right? The income tax chapter. Now, we continue reading. Gross income includes any amount received as an annuity, whether for a period certain or during one or more lives, under an annuity, endowment, or life insurance contract. So the rule is include in gross income annuities, endowments, or life insurance contracts. Now note the language or, and you're going to see this throughout. Many times I'll bring it up later on when we see it, but you'll see lots of and or language in the tax law. This is a perfect example of or. It can be any of these things and it's considered included in gross income. It can be annuities, or it can be endowments, or it can be life insurance contracts. All 3 of those things separately, if you get an amount of what those are, but we don't know what that is yet. We haven't defined that. We haven't looked at the definition. All 3 of those independently are considered gross income. You don't need to have all 3 of those is what the point is, okay? So we know what the general rule is to include. Now, I want to show you some referencing. Many of you already know how to reference code sections, right? You know section, subsection, paragraph, subparagraph, clause, subclause. So 72, subsection A, general rule for annuities. Then we have paragraphs, paragraph 1 and paragraph 2. Look down here to A. So if I asked you for what this level is, where I have the arrow, that's going to be section 72, subsection A, paragraph 2, subparagraph cap A, or subparagraph A. Okay, that's how we would say that. Okay, now look, as I mentioned, we get really, really nitpicky at times. For purposes of applying subsections B, C, and E, so again, you look at you look at the level. This is very important. You look at the level that it defines things at. It's very, very important. All right, let's keep reading down. Exclusion ratio. So this is an example of, actually, and we'll see better examples later on, this is actually an example of an exception. Now, how is it an exception? Remember what the general rule was. The general rule is a tax treatment rule here. Tax treatment rule says that we're going to include in gross income those three items: annuities, endowments, life insurance contracts. Notice it says exclusion ratio B in general. Gross income does not include. Not include means exclude. Now this does not mean that the tax treatment rule of section 72 is to exclude. It just means that there's an exception to the general rule of include. It says that gross income does not include that part of any amount received by as an annuity under an annuity, endowment, or life insurance contract which bears the same ratio to such amount as the investment in the contract, as of the annuity starting date, bears to the expected return under the contract as of such date. So what is this? So some of you that already know a bit about tax law, this is the exclusion ratio we use in the annuity area for when you receive an annuity. And what you do is you take amount received during the year. So by definition, if you keep reading in this, you'll see that annuity is basically any time that you receive multiple payments over time, over more than one tax year. That's what an annuity is. So if you receive, it could be a certain period of time, 10 years, that's considered an annuity, okay? Or it could be for the rest of your life. So it might be an indefinite period of time where you're not sure about. That's still considered an annuity. So the amount received during the year, during the tax year in question, what you're going to do is the exclusion rate, you're going to multiply that by the exclusion ratio. The exclusion ratio is the amount invested personally by that person. So if you bought an annuity, you bought some type of life insurance contract for $100,000, that's what you would put there. It's the amount invested over what's expected to pay out. And again, this is expected, especially if you have something that pays over a life, okay? So perfect example, take me. So I teach at a university, and on retirement from the university, I will receive a defined benefit pension plan. And I'll have options. Let's just say I pick the one that goes for the rest of my life. I'm going to receive a certain amount each year for the rest of my life. Now, there's tables that we use in the IRS regulations, that provide your expected life, what your expected life expectancy is. And you multiply the amount you're going to receive per year by the life expectancy, and that's your expected payout. So that is your exclusion ratio. What it's saying is the amount received during the year times this ratio is going to be excluded from gross income. The rest of it, right, you'd subtract the excluded amount from, we'll just call this item A. Let's just do a cap A. So you take the excluded amount minus what A is, and the A signifies big A, amount received during the year. So you subtract that amount, and that's going to be the amount included, because those two amounts together will equal the amount received during the year. They'll equal out. And that's how we do this, okay? Now, section 72 is a very long code section. When you're watching this video, I recommend very, very wise, very, very strongly, and it's very wise of you to do so, combine those two ideas, right? Stop the video. Take notes, of course, but also read through the rest of the code section, because section 72 is very long. There's a lot of times in the code sections, many times, you'll see a definition section. So definition, investment in the contract, what that means. So you can find what the definition of that is. And that's one of the things that we just looked at. So it provides definitions for purposes of subsection B. So it, again, provides that level of where it is. So the level is very important, right? It's not for purposes of the subtitle. We're not defining that for every code section, that subtitle, just for purposes of subsection B. And you can keep reading. You can read all these different things. It defines a lot of these items, and it goes through. Now, again, we're just focusing on the code, but as I mentioned, there's regulations that relate to this, and they provide the life expectancy and things in that nature, okay? But we're just focusing on the code here. But go through, stop the video, and read we're going to read through. Just kind of get the language. I've kind of highlighted the most important things, but you're going to need to read everything through this. You'll actually see throughout the code section, you might see some areas that are repealed. If they're repealed, that means that Congress, it took out that language. There might have been something that Congress just took out. They no longer wanted that in the law, and they've gone through that. Anti-abuse rule. See that. I mentioned in the top 100 tax code section video that a lot of the complex tax law that we have is what's called anti-abuse rules. So basically the idea is that anti-abuse just means that Congress is trying to create rules to stop loopholes. Different taxpayers take advantage of the tax rules different ways. So if you ever see anti-abuse rule, that means that Congress is saying, hey, you can't do X, Y, and Z, so we're putting a rule in place that won't let you. Okay? That's what they do. So again, read through some of these areas. Again, it's a long code section, but if this is your first time ever reading code section, it's very, very important that you go through and read this. Okay? Skim. Don't memorize everything. And one thing I want to highlight, if you're taking my class, is I'm providing you with this code, right? And again, the page numbers you have there. So you can get kind of accustomed to where the page numbers are because this is the same document you're going to be using on the exam. But don't memorize. Do not memorize these things unless you're talking about top 100 code sections and there's something I told you that's very important in that video. But do not memorize. Obviously, as you see, there is a lot of information here. You can't memorize this stuff. Again, the purpose of this video is to help you become a better tax practitioner by understanding how to navigate the tax code, understanding themes that will help guide you. Okay, so when you see certain things, you understand various items. Okay, let's continue on and let's look at section 74. Okay, section 74 deals with prizes and awards. And this one is a very important discussion because, again, we start off with section 61. We're talking about inflows, income. And we determine, hey, do we have gross income under section 61? Now, determine if we have section 61 gross income, we look at part 2, which is section 71 through 99. And these are special rules that help us determine in certain instances. Now, some things are just gross income under section 61. Like, let's say you go on a game show. You go on a game show. Who wants to be a millionaire? Right? Old game show. And you win $1 million. You win the ultimate prize. You win $1 million. Is that gross income? So again, if you went already and you watched the top 100 tax code section video, you will know that is gross income because under section 61, right, we have the 3 requirements under Glenshaw Glass. We have to meet all 3: accession to wealth, realization, dominion control. We have all 3 of those, right? Because our net worth goes up, accession to wealth, realization, we've got severance and the money is separate, and we've got dominion control. We can do whatever we want with the money. Boom, gross income. So some of you might be wondering, well, then why do we need section 74 for prizes and awards? So let's just read the subsection A general rule. Subsection A general rule says, except as otherwise provided in this section or section 117 relating to qualified scholarships, gross income includes amounts received as prizes and awards. Okay, right there. We've got our tax treatment rule. So let's go ahead and write that down. So the tax treatment rule is to include in gross income, so include is the verbiage, in gross income, prizes and awards. So some of you are saying, wait, you just told me that under section 61, the Glenshaw Glass definition, wouldn't the $1 million prize or award that we win from the game show, wouldn't that be under section 61? Why are we here in 74? And the answer is you are correct. Section 61 lays out that rule. But this is what makes tax law so tricky, is that sometimes Congress comes into play and they want to make a rule even clearer. So this is one of the most major examples of this. Under the broad view of income, section 61 prizes and awards, as we saw, would clearly fall in that definition, the three-part test. However, Congress wanted to make clear that prizes and awards are gross income due to issues on TV game shows where taxpayers were trying to make other arguments that, hey, it wasn't taxable. It was a gift or something like that. No, it wasn't a gift. You actually earned this. You did that, okay? Another reason is because, as you'll see below, we've got some exceptions to the general rule, as we normally do. Exceptions for certain prizes and awards transferred to charity. So if we're going to start off with exceptions, then we need the general rule. Now, some of you might be saying, well, then why don't we just put this with the exclusions? That's a good point. But again, Congress wanted to make clear that, hey, prizes and awards, like when you receive game show prizes and awards, those are gross income. So this is one of the exceptions. It deals with gross income does not include amounts received as prizes and awards made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or, here's our or language, civic achievement, but only if, and it gives 1, 2, and 3. And notice it says 3. I'm sorry, and define these items. So you need all 3 of these. You need number 1, number 2, and number 3. And if you want to stop the video right now and read those requirements, go ahead and do that. You might have already learned about this rule. Go ahead and stop and read that point. Okay. So that's the point. And you'll see also, look, there's some or language even within some of these requirements. There's another exception. So we have another exception to the general rule of Section 74, subsection A, right, to the tax treatment rule to include. We've got exception for certain employee achievement awards. You can read that one, okay? You can read that. Again, if you're watching this in the future, the rules may have changed on this one. This one's been changing over time, so be careful of that. But you can see that. That's all I really want to talk about when it comes to Section 74, just looking at specifically, again, we have include, special rule Y, and we also have some exceptions. Let's continue on. Now we're going to go over to Part 3. So now we've determined in our checklist, again, we have Section 61, we have gross income. Or we looked at Part 2 of Subchapter B, right, Section 71 through 99, and a special rule. We determined something's gross income. So the next step, so after you have that, right, yes, we have gross income under Section 61 or Part 2, right, special rules. Yes. The next question, are there any exclusions? Are there any exclusions that apply? And that specifically, you find those in Part 3. If yes, then you don't record it on the tax return. It's excluded from gross income. But if no, you are going to have to record on gross income. Now, these exclusions are where Congress comes in and says, you know what? We don't think it's right to tax it. So we're going to look at Section 101 specifically. It's one of the longer ones. Again, I'm not going to read the whole thing with you, but I recommend you stop and read the code section yourself. It says Section 101, certain death benefits. A, proceeds of life insurance contracts payable by reason of death. A1, general rule. Except as otherwise provided in paragraphs 2 and 3, subsection D, subsection F, and subsection J. So all of those. Gross income does not include amounts received, whether in single sum or otherwise, under a life insurance contract if such amounts are paid by reason of death of the insured. So our tax treatment rule here is to exclude from gross income. We exclude from gross income, and the requirements, it has to be amounts received, single sum or otherwise, under a life insurance contract. So I would say it's requirement 1, if paid by reason of death of the insured. So I think there's really two requirements. Some people might read that and say there's multiple requirements, but you're receiving amounts under a life insurance contract, and the reason why you're receiving it is because someone died and you were listed as the person to receive that. Those are the 2 requirements. So the tax treatment rule, we exclude from income, and the propositions or the requirements or conditions, whatever you call them. Number 1, you have to have amounts received, whether single or some otherwise, under life insurance. So amounts received under a life insurance contract. And 2, the amounts were paid to you by reason of death of the insured. Okay? Now look at number 2 here, transfer for valuable consideration. In the case of a transfer for valuable consideration, by assignment or otherwise, of a life insurance contract or any interest therein, the amount excluded from gross income by paragraph 1 shall not exceed an amount equal to the sum of the actual value of consideration of premiums and other amounts subsequently paid by a transferee. So what is this saying? Well, this is an exception to the general rule. We specifically saw, let's change up the highlighter, except as otherwise provided in paragraphs 2 and 3. So now we're in paragraph 2. Okay? It says that the amount excluded shall not exceed. So it's providing kind of like a limitation. So in a way, this is an exception to the general rule. So this is indeed an exception to the general rule. All right? Now you can go on, you can see these other exceptions. If you go to paragraph 3, you go to subsection D, subsection F, subsection J, you'll see these different exceptions to the general rule. All right? And you can see that. Now, it's important to note that when you're looking at the exclusions under Part 3, remember, if we have gross income under Section 61, you look to Part 3. If you are a new tax practitioner or a student, someone new to tax, the best way to do this is to look at the table of contents and read through the titles of every code section found in Part 3, which is 101 to Section 140, and see if anything in there, if it falls into place. Almost all the exclusions in the tax code are found in sections 101 to 140. So you'll be finding most of them if you look through that area. And look at the titles. Now, some of them aren't clear, right? If you're dealing with life insurance, would you have gotten life insurance from certain death benefits? Well, if it was on someone's death, maybe, right? But so you have to kind of think a little bit, you have to examine some areas. But some are going to be obvious, hey, it's not there, right? If you look at section 107, it deals with parsonage allowances for preachers and stuff. Obviously, that's not life insurance, right? So if I gave you a question, a scenario, deal with life insurance, you might see this later, so maybe keep this in mind. Someone receives money as a result of somebody being named on their life insurance, okay? And you determine, hey, it's gross income under Section 61. If you actually look at Section 61 like we did earlier, one of the examples listed in that not exhaustive list actually says proceeds received under life insurance. So that means, hey, proceeds received under life insurance would be Section 61 gross income under the general rules. But we still have to go and we say, hey, but does it fall under any of the exclusions or Part 3? If it was a result of someone's death, yes. If you were named, okay, we get to exclude it. That's how it works. So if you're dealing with something like municipal bond interest, you read all the titles and until you find something that relates. And again, you want to think broad, right? Insurance, you don't get the title insurance in Section 101 here. Think broad because Congress keeps broad. And if you see certain death benefits, it's on someone's death, you got to say, hey, that may apply. Let's read it. And that's how tax research works when you first start out. Obviously, when you get more versed in the tax law, it's going to be a lot easier. But that's how things start out. All right, let's now continue on. Let's look at Section 111. So Section 111, the title is Recovery of Tax Benefit Items. Recovery of tax benefit items. Keep that in mind. This one is a very difficult. So if you were looking through the Part 3, again, looking for something, hey, I have Section 61 gross income. Any of these exclude me from gross income? As you go through and you look at that. Well, if you look at a title like Recovery of Tax Benefit Items, you're like, what does that even mean? If you get to that, you should probably at least read. And maybe read like the beginning. At least the general rule, towards the beginning. You don't have to read the whole entire code section. You should get the gist of the code section from the first, few paragraphs. For the first few, I shouldn't say paragraphs, right? Subsections or whatever. Okay, just read the first few. So it says, A, deductions. Now we are in Part 3, which remember deals with exclusions from gross income. So we are in Part 3 of the inflow area. Now, this is really confusing because some of you are saying, well, why does it say deductions? Aren't we dealing with the inflow of income? And we are. This is found in the inflow of income. Let's just read it. Gross income does not include income attributable to the recovery during the taxable year of any amount deducted in a prior taxable year that such amount did not reduce the amount of tax imposed by this chapter. So what's saying there, this is known as the no double tax benefit rule. And this is an important theme in tax law. I talk about this in my top 40 tax doctrines video. We'll also see this in Code Section 265 later on. But what's saying is there are certain transactions in the tax law, and this is actually it's viewed there's two sides of the coin here, right? You have a coin, you have two sides how this works. What it's saying is that if you were supposed to get a tax benefit and you didn't get benefit, then you don't have to include that amount in a future year, okay, if it's related to that. So that's what it's saying. However, so side 1, it deals with that. Side 2 is a little bit more common that we see. And what that is if, let's say you have state and local taxes. State and local taxes, you're allowed to deduct. If, let's say, you're a business, you're allowed to deduct your state and local taxes, like income tax or property tax on your tax return if you're a business. And let's say you overpaid. So year 1, you pay $1,000 of state and local taxes. Year 2, you're only supposed to pay $800 on your tax return, so you get a refund of $200. Well, because you got the benefit of a $1,000 deduction in year 1, you have to include $200 in year 2, the refund received. Why? Because you didn't actually you didn't actually have $1,000 in taxes. So the idea there is you don't get two benefits. You don't get to both exclude and deduct. And the way I like to think about this, what are the two tax benefits? Well, what do taxpayers want? When it comes to income, they don't want to pay tax on income, so they want to exclude income. When it comes to deductions, they do want deductions, so exclude and deduct. Those are the two benefits. Many times in the tax law, you cannot get both. You don't get two bites of the apple. So that's what no double tax benefit deals with, okay? And you'll see this side 2 element pop up again in section 265. Now, that's all I want to mention. So sometimes code sections are kind of shoved in here, but they don't really fall into place that well. That's all I want to mention there. Very interesting case. But you'll see all the other code sections in the 101 to 140 area, they really are exclusions. They kind of follow that same format of section 101. So let's continue on, and now let's move over to deductions. All right, so now we're looking at the deduction area, and look here, section 161, allowance for deductions. In computing taxable income under section 63, so that just means in computing taxable income, there shall be allowed, so remember, the language for deduction is allow versus disallow. As deductions, the item is specified in this part, which is part 6, subject to exceptions under part 9, which are the disallowance rules. So what this code section is saying, remember we had section 61B, the cross-reference section? Remember section 61B, it provided our checklist, right? Where we went through, we said, hey, if we have section 61 gross income, if we don't have section 61 gross income or gross income at all under part 1 and part 2 of subchapter B, it's not on the tax return. But if we do, we have to ask, are there any exclusions? If there is an exclusion, not on tax return. But if there's not an exclusion, it is on the tax return, right? That's what section 61B, it said, hey, you have to look at part 2 and part 3. Well, section 161 says, okay, for deductions, we start here below at section 162, at this part 6. And then we look at all the deduction provisions, part 6, part 7, part 8. And there's other deduction provisions in the tax law. But if you do not have a deduction under section 162, so there's no allowance provision, then it's not allowed in the tax return. You're not allowed to get it. But if there is an allowance, a specific allowance, then you have to continue on and you have to look at part 9. And part 9 is disallowance provisions. If there is a disallowance, so yes, then it's not on the tax return. But if no, then it is on the tax return. And that's how it works. And that's exactly what section 161 says. It sets up that order. So keep that in mind when you're looking at these deduction areas. Okay, let's look at section 162. Section 162 is one of my favorite code sections because, like section 61, it's like one of the main, and again, it's in my top 100 list, so I talk more about it. Section 162 deals with trade or business expenses. It's a very long code section because it deals with a lot of stuff, but by far, section 162, we start off here. There shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business, including. Now that code section right there is the most litigated code section in the entire tax law. I'll explain why in a moment. Before we do, remember Supreme Court of the United States, also known as SCOTUS. Supreme Court of the United States, through various case law, again, New Colonial Ice is the main one, said that income is to be construed broadly and deductions narrowly. We talked about that earlier, and we talked about it in other videos. So since we're talking about deductions here, that means if you're questioning something, if you're not sure, the courts are to rule on narrowly construing deductions, meaning that you don't get it. It's not allowed. Okay? Now, the reason why this code section is the most litigated code section in the entire tax law is because these terms, ordinary, necessary, expense, paid or incurred during the taxable year in carrying on any trade or business they each have their own line of litigation. Ordinary, it's okay, we define what ordinary is. That's the question. What does ordinary mean? What does necessary mean? Expenses. Okay, what is an expense versus what is a capital expenditure? Paid or incurred. That's a timing issue. Did you get it this year? Did you accrue cash method? All that stuff. During the taxable year, what is the tax year at question? Is it a fiscal year? Is it a calendar year? In carrying on, this deals with, are you already existing in a line of business or are you entering a new line of business? Any trade or business. Are you a trade or business versus are you investment versus personal activity? And by the way, the big three, and I'll mention this also when we look at section 165 after this one, the big three, remember, we have business activity, investment activity, and personal. And in that order is what you want. Because personal activity, as we're going to see when we look at section 261 later on, section 262 later on, the general rule for personal when it comes to deductions is that personal deductions are not allowed unless you can find a specific provision that allows a deduction, like mortgage interest or medical expenses, right? Personal mortgage interest and personal medical expenses are allowed as a deduction, okay, subject to limitations. Business and investment, the general rule is you can deduct, okay, deductions related to those things, but there, of course, there's limitations, and then business is the least limited. So in that order, that's how we would go through, okay? That's how we would go through the items. Now, that's all I really want to say about Code Section 162. You can also stop and you can determine the tax treatment rule and you can see if there's any exceptions. Again, I highly recommend you go through and read the code section just to get an idea of what's going on. But the tax treatment rule here, again at the top, almost always at the top, is that there's a deduction allowed. There's an allowed deduction. And specifically, you have to have ordinary, necessary, expense, paid or incurred during the taxable year in carrying on any trade or business. You need all 7 of those things. And also, by the way, and this is another thing I should mention as a theme, the requirement of substantiation. Substantiation, which means showing receipts and records, that's also kind of an implicit condition. Notice, nothing in section 162A, subsection A, says you need substantiation. However, the courts over the years have added that in there. Now, when you look at other code sections, we're going to take a look at section 274, substantiation comes into play there at times, and you can kind of bring that in at times, but the courts have said, there's also an additional requirement that Congress didn't lay out, and that's substantiation. We're going to interpret that because they just thought that was, an underlying implicit item. So that's another tax theme, is that sometimes not all conditions will be laid out in the code. You might have additional requirements, so that would be requirement number 8, is that you need proper substantiation. You need proper receipts. Okay? Again, please go through section 162. 162 is a very big one, and we might see it later on. We might see something in section 162 in a scenario, so please take note of that. Okay, section 165. We're going to go a little bit faster now because we got, quite a few code sections to go through. Take a second, stop the video, and do the tax treatment rule for this section. Okay, so section 165 says losses, general rule, there shall be allowed a deduction. So right there we've got our tax treatment rule, TTR. You're allowed a deduction, any loss sustained during the taxable year and not compensated for by insurance or otherwise. The amount of the deduction is specified in subsection B. Limitation on losses of individuals. So remember the big 3, right? Business, investment, and personal. So let's look at this code section. C1, C first. In the case of an individual, the deduction under subsection A shall be limited to losses incurred in a trade or business. So if we're talking about individuals here, they're referring to a Schedule C type activity or flow through. 2, losses incurred in any transaction entered into for profit, though not connected with a trade or business. So we're talking about investment. And 3, except as provided in subsection H, losses of property not connected with trade or business or transaction entered into profit, if such losses arise from fire, storm, shipwreck, or other casualty, or from theft. So it's saying that personal casualty losses, so from casualty events. So from this, what it's saying is that, hey, individuals are limited. Individual type taxpayers are limited. They can take business, if you have a Schedule C type of activity, or investment, or if it's a personal use activity, then from events like fire, storm, shipwreck, or other casualty like hurricanes, tornadoes, those types of things, okay, or theft. Now, again, very important code section. Please read through this one. That's all I really want to highlight when it comes to this code section. All right, now we're moving on to the disallowance. We're now in part 9 of subsection B, right? Still dealing with subsection B. It's a big one, right? Woo! We saw that in top 100 tax code section video. Subsection B is a big area, right? Because it applies to all different types of taxpayers, whether you're individual, corporation. These are almost all these rules apply to all types of taxpayers. So part 9, now we're talking about the disallowance provisions. So when you're looking at the tax treatment rule, you're going to see that almost all of these tax treatment rules disallowance. So section 261. General rule for disallowance of deductions. In computing taxable income, no deduction shall in any case be allowed in respect to the of the items in this part. So it's just saying, hey, you look at part 9 for disallowances. So it's setting again, hey, you start with part 6, 7, and 8, or other deductions in the code, right? So for example, section 162, if you have a trade or business, or some other deduction provision, right? Then you got to ask, okay, well, we have a section 162 trade or business from that section, but we then have to consider part 9. Are there any disallowance rules in part 9? If there is a disallowance rule in part 9, no deduction, you can't take it on a tax return. But if there's not, yes, you do get it on the tax return. So that's how this works. So let's continue on, and let's look at section 262. So section 262 is personal living and family expenses. This is where we find the general rule that personal use expenses or personal living and family expenses are not allowed. So general rule, except as otherwise expressly provided in this chapter, right? No deduction shall be allowed for personal living or family expenses. So that gets us to the big 3 activities, saying, hey, the general rule for personal use is that you can't deduct it unless there's some other rule. Unless there's an exception. That's what the first part, except as otherwise provided in this chapter. It's saying, hey, you have to show me another rule that says otherwise, like mortgage interest, medical expenses, certain tuition for personal, if you're doing it for your personal benefit, right? That's what it is. If it's in business or investment, that's not the case, okay? So that's what we're showing here. Now, the tax treatment rule is disallowance. So when it says no deduction shall be allowed, that means it's a disallowance provision. We cannot deduct. Disallowance of deduction, okay? And it says treatment of certain phone expenses. You can read about that. All right, section 263. So section 263 deals with capital expenditures. Just another example of a tax treatment rule of disallowance. It says, general rule, no deduction shall be allowed for. So that language, that's what means disallowance. So tax treatment rule, disallowance, and it sets the stage for what it is. And then subsection A, paragraph 1, any amount paid out for a new building or for permanent improvements or betterments made to increase the value of any property or estate in this paragraph shall apply. And it talks about various code sections. So it's basically if you're purchasing building or making improvements, it talks about intangible drilling and whatnot, okay? And what it's doing is basically the issue is if you purchase a building or certain property, and the question is, can you deduct that purchase? Well, this section is saying a capitalization rule where, hey, maybe other code sections, you can take the deduction. So if you continue reading, you see all these different types of areas. This is a long one. 263A is a unicap area, but basically provides, how capitalization occurs. That's all I want to show you with that one. So just go ahead and read through the language. I just want to point out that this is part 9. We're dealing with disallowance provisions. So this is a Part 9 disallowance, Section 263. And again, looking at that checklist, you would think that Part 9 would be the end. But after you look at Section 263, 263 is a little weird because sections like 167 or Section 179 or 197, they provide special rules that say, hey, if you had to capitalize under Section 263, then you might be able to deduct or amortize or take deductions for amortization, depreciation, or special deductions under these rules. So it kind of comes back in full circle. So it shows you tax gets a little complex at times, how the structure works. But again, the structure that we did, right, we start off with the allowance. If there's no allowance, then you stop, right? You can't take anything. But if there is an allowance, you go to Part 9. That still continues. We still follow that general rule, okay? So just keep that in mind. Okay, Section 265. So Section 265 is the no double tax benefit idea. We saw this in Section 111. I just want to bring it up because, again, the no double tax benefit doctrine is part of my top 40 tax doctrines out there, and this one's very important. It's a very important theme in tax. So remember, just to review, when we looked at Section 111 earlier, the two benefits in tax that we think of are exclude and deduct. You can also make a case for credits, right? But the main ones are exclude and deduct. Credits are not as common. And that's what the taxpayer wants. They want to exclude income. They want to take deductions. They don't want to include it, and they don't want disallowance of deductions. So this one says, Section 265, expenses and interest relating to tax-exempt income. General rule, no deduction shall be allowed for, so it's a disallowance rule, expenses, any amount otherwise allowable to deduction which is allocable to one or more classes of income other than interest. And I'm going to skip that little area. Wholly exempt from taxes imposed by this subtitle or any amount otherwise allowable under Section 212. And it talks about interest and whatnot. So basically the idea here is, let's say that, and I give the same example in my top 100 tax code section video. Let's say you borrow money. You borrow $100,000 from a bank you have good terms with, and you pay, so $100K. You pay 3% interest. And you take that $100,000 and you invest the $100,000 in corporate bonds. I'm sorry, City of Atlanta bonds that pay 6% interest. Now under Section 103, right? So let's go through this. Let's think about this, right? Interest, if you start off, interest is an inflow, right? So let's look at the interest that you receive from the City of Atlanta, the bonds. That's an inflow. You have money coming in. So think of inflows and outflows. Inflow coming into you. So the question is that inflow going to be gross income? So then we go to part 1 of subsection B, section 61. So we start there. And we say, is this interest considered gross income? And again, we're just looking at our Glenshaw glass, 3-part test. 1, 2, 3. Accession to wealth, right? You have this money now? Yes. So it is an accession to wealth. Your net worth's gone up. There's no corresponding liability increase. The interest portion, not the principal portion, the interest. Second, realization. Is it severable? Yes, it's separate from the bond itself, right? You get this $6,000 per year. Finally, dominion control. Can you do whatever you want with the money? Yes, you bet. So you've got all three things. You've got gross income. We didn't even need section 71 to 99 to make this determination. So we do have gross income. So the next thing we do is we look at part 3, right? We look at part 3 for exclusions. And the answer is, do we have an exclusion? And the answer is yes. If you look at section 103, if you want to stop the video, go through the table of contents, you will see state and local bond interest, section 103, is excluded from gross income. Assuming City of Atlanta qualifies as that, we will say it for this example, it does. So that 6% interest or $6,000 per year of interest is not included in gross income. It's not included. Not included. So then the question becomes, this is all an investment activity, right? For this person. That 3% interest that you pay, okay, we dealt with the income issue. Can we deduct the $3,000 per year in interest we pay? Well, generally speaking, subject to limitations, yes, you can. If you look at section 163 dealing with interest expense, you're allowed to take interest deductions up to the amount of interest income that you earn, and you have $6,000 of interest income, so you could offset it. However, section 265, so that's what we would do. You would say, okay, for the deduction, you go to the part 6, you find section 163 interest, and you find, hey, for investment interest, yes, I have an allowance. I can do it. But remember, if you do have an allowance, the next step is to go to Part 9. Under Part 9, are there any rules that would say you're not allowed to take it? It's disallowed. And you find it here in Section 265, so it's disallowed. Why? Because as it says, if it relates to tax-exempt income, so the interest you're paying on, the $3,000, was used to secure the bond that pays tax-exempt income. So you're not allowed to take the $3,000 deduction. You would be under Part 6, Section 163, but now you have this rule which trumps it because that's the way that we do these rules. So that's another example of how this all fits together in this puzzle. That's why I love tax, like a big piece of puzzle, right? I showed you my tax theme video, my Tetris suit, and I talk about the puzzle of tax, and that's a very important element. Okay, let's look at Section 274. So Section 274 is one of the most commonly known of the disallowance provisions. I just want to bring this up. So Section 274 has a lot of stuff. Section 274, disallowance of certain entertainment, etc. expenses. So A, entertainment, amusement, recreation, or qualified transportation fringes. Again, you might be watching this video. You might be watching this video in the future. Things may have changed, so don't rely on this. I'm just going to mention it to save time. We've already gone so long. But the idea here is Section 274 has a lot of disallowance provisions. And please read through Section 274 if you're dealing with this. There's rules for gifts, entertainment, meals. So the meals rule, I know many of you already know about this, but meals are limited in terms of how much you can deduct. And if you go through Section 274, you're actually going to find that subsection that focuses on meals, the limitations on meals. And there's regulations and whatnot that interpret, and there's case law. But the idea here is you define, right here, Section 274K, business meals. So right there, we've got some rules on business meals, and there's also many other limitations out there in this code section. So just make sure. I just want to show you that, right? Meals is a common one. Section 274 has a lot of stuff. Again, it sticks with our disallowance rules. All right, so now we're done with deductions. We're done with subchapter B. Now we're going to move on to some of the property stuff. So let's look at Section 1001. So kind of changing focus. Remember, our tax treatment rule for income is include versus exclude. For deductions, allow versus disallow. Now I want to talk about property. So property transactions, which again, subchapter O of the Internal Revenue Code deals with property transactions. Well, subchapter O and P. O deals with the calculation. P deals with the characterization. Section 1001 is always the starting point for property transactions. And that's where we determine the calculation of realized gain or loss. And it says it's the amount realized minus the adjusted basis. And it defines that definition there. And you find in B, the definition, subsection B, the definition of amount realized. And it takes into account all of those things. Look at subsection C, recognition of gain or loss. Except as otherwise provided in this subtitle, so the entire subtitle of income tax, the entire amount of gain or loss determined under this section on the sale or exchange of property shall be recognized. So this gets to, when you're dealing with property transactions, the lingo is to recognize gain or loss or not recognize gain or loss. And what this is saying, it's saying that the general rule for property transactions is all gains and losses are recognized unless there's a specific rule, except as otherwise provided in the subtitle. Okay? And those are known as non-recognition rules. So 1001, I just wanted to highlight that you have this starting point of where you always go with property transactions, calculating realized gain or loss, which is amount realized minus adjusted basis. And that gives you the realized gain or loss. Now, by the way, and I mentioned this in the other videos, the difference between realized gain or loss and recognized, as many of you know, recognized gain or loss is what goes in the tax return. So if it's recognized, it goes in the tax return, it gets reported. Realized gain or loss, though, comes before. Why? Remember that Section 61, Glenshaw Glass, right? 3 requirements, right? We have to have an accession to wealth, which means your net worth goes up. What was the second requirement? You need realization. Realization, that's what the realized gain or loss component is. Basically, it's a sale or other disposition of property. And what that means, and that's what's a sale or other disposition. So we're talking about sales, exchanges, trades, involuntary conversions, events like that. And the idea is when it comes to property, our tax system, we don't just simply tax the increase in value of wealth. We don't have a consumption tax system either. So, for example, if you own stock in a very big corporation, New York Stock Exchange Corporation, and you purchase it at the beginning of the year for $300 per share. At the end of the year, it's now worth $500 per share. That $200 increase in value, unless there's some type of event that triggers that gain realization, you don't have to record it. And that's what requires that, is that realization component. That realization, okay? The realization component of gain or loss. And that's why we have realized gain or loss, then recognized gain or loss comes next. Now, why do we have recognized gain or loss? Because Congress feels that certain events, it's not appropriate yet to tax the recognized gain or loss, or the amount of gain or loss, I should say. So we're going to talk about that when we look at section 1031 in a moment. So let's move on over to that code section. All right, so we have section 1031. If you read the title, exchange of real property held for productive use or investment. So this rule, many of you already know, and this is where we find it, like-kind exchange. Like-kind exchange rules in the tax law. Also known as section 1031 transactions. That's where the title comes from. So if you ever seen that. So the general rule is found here in subsection A, and it says, non-recognition of gain or loss from exchanges solely in kind. In general, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So a few things to note here. The tax treatment rule is to not recognize. So no gain or loss shall be recognized. So non-recognition is the tax treatment rule. So we do not recognize. So non-recognition, that's the tax treatment rule. Now, propositions, we have to have real property. That's one thing. One thing that's a theme is property. As you know, property, legal classification of property, right? We have real versus personal. Not personal use, different from personal use, right? There's personal family living, which I call personal use, and there's personal property. So real property is the land and everything attached to the land. Personal property is all other property. So that includes all intangible property and then all tangible property other than, again, the land and everything attached to the land. So land, buildings, and the things attached to the buildings are going to be considered real property. So here it says only real property. So that means, nope, we don't get personal property. And that makes a big difference in the tax law, especially when we look at code sections like 1031, 1231, depreciation like section 167, amortization like section 197, different areas of the code where property is important. And you'll find many more code sections out there where property makes a big difference in the requirements. So conditions, so no gain or loss is recognized. That's the tax treatment rule. On the exchange, that's the first requirement, of real property held for productive use in a trade or business or for investment. So that's the next one. So held for productive use in a trade or business or investment. If such real property is exchanged, so solely for will be the next one. So just for real property of like kind, which is to be held either for productive use or in a trade or business or for investment. So that's how you would break down the conditions. So you have to have an exchange of real property, so giving up real property in exchange, held for productive use in a trade or business or investment, so you hold it that way. You hold it that way. If such real property is exchanged solely for, so that if such real property is exchanged, that's kind of like, it's just, trying to help the sentence. Again, you have people drafting these English majors and history majors and whatnot, and drafting these things in Congress that are attorneys. Solely for, so exchange, real property held productively in use in trade or business or for investment, solely for, you're getting real property, which is like kind, which is held either for productive use in a trade or business or for investment. So you're giving up real property in exchange, held productive use or trade or business, and you're getting solely for, you're getting just real property of like kind, held either for productive use in trade or business or for investment. There's exceptions, of course. We have them listed here. Got some exceptions. All right. Now there's two more major tax themes I want to talk about when it comes to non-recognition. First thing I want to mention non-recognition of gain or loss is not the same as exclusion. It's not the same as exclusion. So 2 non-recognition themes. 1, non-recognition is not exclusion. So we saw exclusion provisions in the 100s, right? 101 to 140. That is not the same thing as non-recognition. It might seem that way because it's saying no gain or loss shall be recognized, but it's not the same thing. Exclusion is permanent. Non-recognition is temporary. Okay? So what do I mean by temporary? It means that gain or loss that you didn't have to recognize, it gets basically preserved in the new asset, right? So in this exchange, you're giving up an old piece of real property and getting a new piece of real property. So that gain or loss that you would have had to record, it gets preserved in the new asset, in the new real property. How does that happen? Well, if you look, every code section has a corresponding basis rule. And the basis rule here, let's see if we can find it right here, D, basis. And if you read that, so every non-recognition rule has a basis rule. D, basis. If property was acquired on an exchange described in this section, or 1035A or 1036 or 1037, blah, 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 the basis shall be the same as that of the property exchange, decreased for various items of boots and law and mortgage and different things like that. So basically it says you roll over the basis of the old to keep the other one preserved with adjustments for certain things. So right there, bam, you see how that works. That right there shows you that non-recognition is not the same thing as exclusion. Many tax students, when they first take a tax class, they either don't learn this because the teacher doesn't really stress this, or sometimes even, I don't want to, this doesn't happen that often, but sometimes the faculty member, they make it seem that they are the same. They're not. They're timing. They're timing differences. Exclusion is permanent, meaning you're never going to have to recognize that gain or loss. And non-recognition means that it will be preserved in the future. It will be preserved in the future. The second thing I want to stress is that every non-recognition rule has 2 common things, 2 common themes. So a theme within a theme, right? Every non-recognition rule has 2 common themes, 2 commonalities, or I'll just put 2 common, okay? And again, as I mentioned, these are things that Congress comes in and says, hey, we don't think it's right to tax this transaction right now, okay? This transaction currently. I'll list these as A and B since I already have number 1, number 2 as the themes. The first thing is that the taxpayer's economic position, the position before, is pretty much the same after. So the economic position before equals after. So if you have an apartment building, you're trading for an apartment building that's pretty much of equal value, you're pretty much economically in the same position before and after. You still have an apartment building, right? You didn't trade it for cash or something like that. Second thing is that liquidity. If there's a liquidity concern, meaning there's no cash to pay the tax, then Congress will allow for non-recognition. But you need both of these things to have. Every non-recognition rule has both of these. So liquidity concern, meaning that, hey, if you're trading $100 million apartment building for another $100 million apartment building, and it would have caused you to recognize a $10 million gain. Well, if you're a corporation, let's say that you're paying, just make it easy, I know this isn't correct rate, but 20% tax rate, that's $2 million in taxes. Well, if nothing changed hands in terms of money, right, it was just apartment building for apartment building, where are you going to get $2 million from? You're going to borrow it? Or you're just not, maybe you won't even engage in the transaction. Well, Congress wants these transactions to occur. They want these businesses to be able, and these investment activities, which is what applies here, right? That's the conditions to actually go through, because we don't want to stifle the economy. So that's very important, and Congress looks at that, okay? So every non-recognition rule has that in place. So keep that in mind. Now let's move on and talk about some of the other capital gain and loss, some of the other property rules, specifically characterization. This is section 1221. So now we're moving over to subchapter P. So we're now dealing with characterization. And when it comes to characterization, as many of you know, taxpayers can have ultimately at the end of the day, three different types of character. There's short-term capital, gain or loss, long-term capital, gain or loss, and then ordinary. And there's no difference between short-term and long-term ordinary. Now, long-term capital gain is where there's preferential rates for individual taxpayers, those types of taxpayers. So keep that in mind. So if we have a gain among these three options, taxpayer wants long-term capital gain because preferential rates, right? The lower rates. Okay. Now there are special rates for certain transactions, but generally speaking, lower rates. If we have a loss, taxpayer prefers ordinary loss, and the reason why, there's two reasons. The first is that you're offsetting, you're offsetting ordinary income, which is taxed at a higher rate. So the offset against ordinary income, OI. And then less limitation compared to capital losses. Less limitation compared to capital losses. So always keep that in mind. Keep that in mind that taxpayers, they prefer, when it comes to a gain, a long-term capital gain, loss, ordinary loss. Also keep in mind that, remember that taxpayers, when it comes to income, and I've kind of stressed this already, and I did in other videos, they want to defer income as long as possible, and they want recording of income as long as possible. And when it comes to deductions, they want to accelerate deductions, and the reason why is time value of money. So they want to take deductions as quickly as possible, unless there's going to be a change in tax rates or carryover issues or whatnot. When it comes to income recording, they want to generally defer, again, unless there's some type of change. They want to push it as long as possible. And the reason why for both of these is time value of money. Paying $1 of tax today costs more to a taxpayer than paying $1 of tax 10 years from now. Again, assuming same tax rates. For deductions, $1 of tax savings today is worth more than $1 of tax savings in the future, again, assuming the same tax rates. So section 1221 is kind of the beginning of when we start considering capital gain, capital loss general rule. Now, the main reason I actually brought up section 1221 is, remember section 61? We had that non-exhaustive list of 14 items we talked about, right? With wages and rents and discharge of indebtedness and all these different things. Well, 1221, it does something as well, but does it a little bit even more different. In general, for purposes of this subtitle, so the entire subtitle, the term capital asset means property held by the taxpayer, but does not include. So this definition actually is, it says, hey, everything is a capital asset except these items. Except, and it lists these items, and it goes through and lists these various items. Now, if you read this list, and I want you to stop the video and read number 1, number 2, 3, 4, and so on. And again, if you're looking at this in the future, things may have changed. But there's actually a court case, and I talk about this in my top cases, that a Supreme Court case that actually says that this list, just like section 61, is non-exhaustive. Now, that's interesting because if you read the language here, and I'll give you a second to, again, pause the video, read section 1221 and read section 61. If you read section 61, it's clear that that the code section was not intended to capture all those items. But if you read this, it looks like the code section is specifically trying to say just these items. But then the courts interpret it to say, hey, there could be other things. Again, makes tax really, really confusing. That's all I really want to say about this code section. All right, this is section 1231. The reason I bring up this is for two elements. Section 1231, it's part of the subchapter P, dealing with characterization. I mentioned that there's really ultimately three characterizations: long-term capital, short-term capital, and ordinary. That is a true statement. Now, there are quasi characterizations like section 1231, section 1245, section 1250, and there's others, but ultimately they end up getting to that long-term capital, short-term capital, or ordinary at the end of the day in the tax return, very end. So section 1231 is one of these quasi characterizations. So that's the first thing I wanted to stress, is that you might be, hey, I thought you said long-term capital, short-term capital, and ordinary, but what about 1231? Well, 1231 is a characterization, but it's a quasi-characterization. The reason why, and I have a video, you can watch this, it explains section 1231 in under 10 minutes. That's actually what it's called. Basically, yes, gains and losses can be classified as Section 1231, but at the end of the day, for the tax year, Section 1231 gains and losses have to be classified as long-term capital or ordinary based on the hodgepodge analysis. And that's for everything. 1245, 1250, same thing. Okay? Now, other thing, you see property. Remember, when you see property, we have to make the distinction between real property and personal property. Already did it earlier, right? Real is land and everything attached to land, and personal is everything else. But if you actually go through here and you look, you go down 1231 subsection A, and we're in paragraph 3, section 1231 gains and losses, and it starts defining things. Let's see if we can find anything about the type of property, right? It says property used in trade or business. Let's see if we can, if there's anything listed yet for real versus personal. Nothing yet. Let's continue looking. If we see anything, I might have passed something. Right here, definition of property used in trade or business. This is subsection B, section 1231, subsection B. So right here, we've got a list of types of property. Property used in trade or business means property used in trade or business of character which is subject to the allowance of depreciation in section 167, held for more than 1 year, and real property. So it's making the distinction at times. So again, real property is very important versus personal property. So keep that in mind. Another thing I want to mention, I just like to bring this up. Section 1231 is one of my favorite code sections. I know I have a top 100 favorites, right? Or top code sections, most important tax code sections. But section 1231 is one of my most favorite because when you're looking at, again, we just talked about this with section 1221, when you're looking at what the taxpayer wants, right? If it's a gain, they want long-term capital gain. If it's a loss, they want ordinary, right? That's their preference. That's what they want. Well, guess what? Section 1231, it does exactly that. If it's a loss situation, it results in everything being treated as ordinary, subject to the sub-hodgepodge versus main hodgepodge rules. I don't want to get into those. Again, watch my 1231 video. But if it's a gain, it will be long-term capital. Everything is classified as long-term capital. So it gets us to the best of both worlds. So let's continue on. And our last code section we're going to look at is section 7701. Okay, so section 7701, last code section we're going to look at, and then we're going to jump into some actual tax scavenger hunts, some scenarios. And the reason why I'm starting off going through these code sections, now once we finish this code section, I really want you to make sure that you go through what we just went through in this video, going through these code sections to look at these tax themes, as well as I want you to rewatch or make sure you've watched my other videos, the top 100 tax code sections and the tax theme, which helps you master tax law. And make sure you understand the stuff in that, because when we go through these scenarios, it really is going to help if you understand the stuff talked about that, because I'm going to be kind of guiding you through how we research and look through the Internal Revenue Code. But as you're going to learn, the more knowledge you have about the tax structure and these themes, it will help you tremendously in doing tax research, especially navigating the tax code. Okay, so here's section 7701. Section 7701 actually is not even found in subtitle A. So I know I have that code for you, subtitle A, but you'll notice there's no page numbers on the bottoms because this isn't actually part of it. But I want to talk about it. It's part of the top 100 tax code section video. And the reason why is because if you can't find a definition in a code section, right? We saw various examples in various code sections when we were looking through them, right? Definition, we just saw section 1231, defined what it says definition of section 1231 property or property used in trade or business, okay? If you can't find a definition in a code section or part or whatever, come here to section 7701 definitions. Because it specifically says in 7701 subsection A, when using this title, look at that. We have not seen title yet. We've been dealing with subtitles, paragraphs, section, subsection. Look at this. That's the entire Title 26. So these are definitions that apply to everywhere in Title 26. Okay? So we have all these definitions. We have all these definitions, and definitely stop the video and read through section 7701. Again, it might change in the future, so do not rely on this as always. Defines person, partnership and partner, corporation. These are very important things because a corporation pays corporate tax, an individual pays tax on individuals. Partnerships, they have a partnership tax. Very important. And it defines these things. So it's very helpful. Foreign, what is a foreign entity? Fiduciary, if you're talking about trust and estates. Stock, what is the definition of stock? Shareholder. United States, state. A lot of definitions here that are very helpful, okay? Taxpayer, just so many different things. Husband and wife, so if you're dealing with husband and wife issues, okay? It defines all these different things. So read through that. Read through section 7701 because a lot of key elements in these code sections are important in terms of definitions. All right. So with that, again, please make sure at this point you've watched, taken notes, go back over this video as many times as you need to, and watch the other videos, the top 100 tax code sections and the tax themes, and taking notes because we're now about to jump into our fact scenarios. Okay, so I'm going to go through 10 different fact scenarios with you, and we are going to take it slow. Now, I highly recommend that you stop the video and try these before I go through them. Now, if you're not sure where to start, then you can watch me do the first one, but please stop. Make sure you read through the fact patterns, at least understand what's going on. Again, I'm going to guide you. We're going to obviously go slower at the beginning, but I'm going to go as slow as possible through all of these. And I'm not going to skip many steps. I'm going to go through all of these in terms of the tax themes. So when tax themes come up and structure and elements I've talked about in the previous videos, I will make sure I mention those and highlight those. Let's go ahead and read the first one. So Staff Sergeant G.I. Jane was a soldier in the Iraq War. Her salary was $2,600 per month, and she was in the war zone for 8 months. Okay, now notice I give you these fact patterns, and I don't specifically ask for income, deduction, credit. I just give you fact pattern. Now, if you're taking my tax research class, for those of you out there watching this, I try to be specific, and I try to say, what's a code section or, a subsection of a code section or a paragraph that provides an exception or it provides, tax treatment for, including income or deducting. I make sure to specify that, but I'm trying to keep it even broader than that to give us an idea. Now, because if you're in practice and someone says to you, hey, I have $2,600 in salary per month from when I was in war, what are the tax consequences? That's kind of the idea. All right, so there's $2,600 per month. And now the amounts for these problems, obviously, if you're filling out a tax return, yes, you'd have to take $2,600 per the number of months, 8 months, right? But we're just really trying to determine the classification, so the calculation isn't that important, right? We've got $2,600 per month. That's her salary she's getting. And she was in a war zone for 8 months, okay? Now, first thing to do, again, always start broad. So I have another video where I go over issue identification. So issue identification. And issue identification, if you think back to the steps of the tax research process, right? Establish the facts. We've already done that. Issue identification is generally thought of as the most difficult of all the steps, especially for people starting out, because a lot of times it's like an art. You have to have an understanding of how things are, what area of law, okay? Now, one thing also to mention, again, for those of you watching and my class, we're only focusing on income tax issues, specifically in the Internal Revenue Code that I provided dealing with the scavenger hunt. So we're talking about subtitle A, and we're talking about Chapter 1. I'm not going to ask anything outside of that, okay? I'm not going to ask anything outside of that. So we issue an identification. We have our facts. So step 1, tax research process, facts. Establish the facts. Step 2, we talk about the issues. We deal with the issues, okay? So issue identification can be very tricky, very difficult. Now, we're just looking for code sections. Again, when you get out in practice, you got code, regs, cases, all IRS pronouncements, revenue rulings, rev procs, private letter rulings, all these different things. We're just focusing, keeping it simple on the code. Issue identification, you always want to start off as broad as possible. And I really mean as broad and as high level as possible. Think as high level, right? 10,000 feet. So what's going on here? Well, Staff Sergeant G.I. Jane is receiving an inflow, right? Always identify, is this an inflow versus an outflow? That's always the first question you ask. And why is that important? Because if it's an inflow, then generally speaking, the issue is going to be whether the income is included or excluded, right? That's what it's going to be. If it's an outflow, deduction, or it could be a credit, right? Credit is, by the way, we didn't talk about the language for credit is utilize. That's the word we use for credit is you can utilize a credit versus you cannot utilize a credit or not utilize. That's the verbiage, okay? But deduction, right, it's allow versus disallow. So here we have inflow, an inflow of potential income, right? So inflow, income. Now, in my previous video, talking about issue identification and the tax research process, remember that I have 5 key questions. I'm not going to talk about all these questions in these videos. A lot of what we're talking about now, it's going to be, we're going to understand that if you need to go back to this part of the video, you can go back. But the 5 questions in tax, I kind of refer to these as my adverb questions, like the what, when, why, how, right? First question is, what amount is included in gross income, if any? Next, what amount can you deduct or credit? And I usually focus on deduct. When can you include, deduct, or utilize a credit? Who can include, deduct, or utilize? And finally, the character. What is the character of the item at issue, right? If it's income or deduction, you can have different characterizations. It could be a short-term capital loss offset. It could be for deduction. It could be, usually it's ordinary, but it could be a short-term capital loss offset. It could be ordinary income or capital gain income. And then credit, obviously, it's just credit. There's no characterization issues there because a credit is a dollar-for-dollar reduction in taxes. Okay, so we are dealing with inflow of income. Now, multiple of these questions might be affected here, but these questions can help articulate what it is. We know it's not going to be this. We know it's not going to be what amount is deducted or credited, but it could be what amount is included in gross income, when, who, and the character. Now, we can pretty much eliminate the who, and the reason why is because there's only one person in this question, Staff Sergeant G.I. Jane. So we know, hey, it's G.I. Jane, right? We know it's G.I. Jane. That's not an issue, okay? Or if it is, I mean, I guess the more proper thing to do, if you want me to be more real or realistic, is there's only one person here in this problem, so it's G.I. Jane. We know she is. So we've done that. Okay. What amount can we do? We already got rid of this question, so that's gone. When? We'll talk about that. What amount in gross income? So far, we've got 3 questions left to identify. What amount in gross income? When do we include it? Not deduct or utilize it, right? We don't do that. And then the character. And again, I'm not going to apply these 5 questions like I'm doing every time. I'm only going to do this for the first question. But try doing this for every one of your questions because it might help you. Might help you articulate what the issue is. Because some issues might be, if it's actually included or it's not included. So it'd be the first question to be up here versus the when. It might be a when question or it might be a character question. Okay? So we have income, we have inflow. Always, if you know it's an inflow question, which it is, right? We're dealing with income. The starting point you always want to start at is section 61. So we're going to start at section 61. We're now going to look at the table of contents because we know section 61, and if you didn't know that, it's okay because I will navigate you through the table of contents and in a moment as if we didn't know that just to get an idea. So let's go ahead and let's jump to the table of contents. So here's our table of contents, and looking at the subchapters, I mean, if you read all these, I'm not going to read every single one of those. You can watch my previous videos. Unless it's like a specific industry or a specific issue, like a corporation or something, we have an individual, then you might want to just start with subchapter A or subchapter B. because those two deal specifically with individuals, corporations, all taxpayers. Okay, all different types of taxpayers. So just keep that in mind. So let's go ahead and take a look there. So subchapter A deals with calculation of tax. It deals with credits. We're not dealing with any of those things because we don't have an outflow. So let's go on to subchapter B. So you read through all these things and you see, and by the way, I know I'm going through all the steps with you, and I know I might go a little fast. If you need to stop and read through all these things because you're getting the hang of things, that's fine. So if you want to stop the video and pause and read everything to see, hey, look, subchapter A deals with calculation of tax, right? We just saw that. So subchapter A deals with the calculation right here, tax on individuals. And if you read these things, it's a calculation. And if you need to go in those code sections to actually see that because you're real new to this, that's fine. Do that. And then credits. Well, we don't have a credit. Part 4 is credit. We don't have a credit here because a credit is an outflow. That's what I'm talking about. Okay. Part 5 is repeal. Part 6, alternative minimum. If you, that's another thing. Some of this is kind of trial and error at first. If there's something you read and you're like not sure, like I don't know, this might be alternative minimum tax, just continue on, right? You're just starting out now. Now you might want to like kind of put a question mark there and say, hey, maybe come back to this if I can't find something else. Base erosion and anti-abuse, right? It's not that. And then part 7 is repealed. So then we have subchapter B. Definition of gross income, adjusted gross income, taxable income. Okay, that looks promising because we know income, inflow. Gross income defined. So we start there. Okay, we start there. Now, we will take a look at section 61 in a moment, but I'm going to do this a little different, right? If you want to stop the video and look at section 61, go ahead and do that right now. Okay, so after looking at section 61, define gross income, what you're going to see, and we're going to go through section 61 together, but if you wanted to stop and look at it, you're going to see, hey, this is where we're going to start. That's our starting point. Now, the Glenshaw-Glass definition of gross income with the 3 requirements, but even beyond that, if you look at section 61, you look at the things for wages, it actually lists as an example wages. So even if you didn't know the Glenshaw-Glass, even if you did not know this, you saw wages and say, hey, this is wages. So therefore, it's an example that's listed on section 61. So wages are included. So we have gross income for section 61. But remember, the way section 61 works is you have a gross income, then you got to go to part 3. Now, for this one, this is where things get real important. What you literally want to do, if you're starting out and you don't know anything about this area of the law, if you know, hey, part 3 is where the exclusions start, and you know section 101. You know the sections 101 to 140 is where you find the exclusions. We know to read there, right? Or if you're taking my tests, right? I'm giving these little tips, to those people who are actually reading, listening this far, which I hope is all my students, but, I'm giving it to the ones that are obviously more diligent. If you're taking my test, by the way, and I give you a question, there's a multiple choice, and I say, which of these code sections deals with an exclusion of, this issue, and the answers are, 121, 1001, 351, and 721. Well, by knowing 101 to 140, maybe you don't know that 121 deals with exclusion of gain on personal residence, which is why I ask about in the question. Now, that's what I would have put on the question. Which of these code sections deal with the exclusion of gain from personal property? By knowing that 101 to 140 is where you'd find that, you can process elimination, right? Answer choices are A, B, C, and D, right? A is 121, right? Because the question deals with exclusion of gain on personal property. I'm sorry, sale of personal property. On sale of principal residence. Okay? So if I put 121, 351, 721, and 1001, right? Even if you don't know what 351, 721, 1001 are, you could process elimination because hey, it has to be in here. And that's kind of also the way that we do tax research a lot of times. If you know a certain area of the tax law involves a certain, hey, this is a corporation, then you look to that area of the corporate tax law. And we will have an example later on for corporation. So you go to those areas. Same thing here. We say, okay, well, we got section 61 gross income, it's wages. We went through that first, and I'm going to show you looking at section 61. We're going to look at the code sections. And then you also want to read every single one of these because you know, hey, I'm going to start with section 101. I'm going to read down until I see anything that kind of strikes my fancy as possible. 101, certain death benefits. Okay, well, she's not dying or no one's dying, so that doesn't apply. Gifts and inheritances. No, we have wages. Interest, so it's not 103. We don't have interest. 104, not compensation for injuries or sickness. 105, amounts received under accident or health plans. 106, contribution by employer to accident and health plans. So far, 101 to 106, nothing. 107, rental value parsonages. That deals with church. If you're not sure about something, always put a question mark. Say, not sure. I don't know what that is. And you can always go through and read it and see what it is. But I recommend reading this first and seeing if something is more closely tied. 108, income from discharge or indebtedness. Okay, well, she didn't owe any money or anything. 109, improvements by lessee on lessor's property. We're not told anything about that. 110, qualified lessee construction. We're not told anything about that. 111, recovery of tax benefit items. Again, if you're not sure, question mark. You can put a little question mark there and you can come back to it. You're looking for stuff that's more clear so you can save time doing research. Okay, so we'll put a question mark on that one. 112, certain combat zone compensation of members of the armed services. Aha, that sounds very promising. Now, if this is your first time looking through the code, I would not stop. I would keep reading because you know, hey, I've got section 61 gross income. There has to be an exclusion. I'm sorry, there doesn't have to be. I'm looking for a possible exclusion. If there's not, we record it. But if there is, then it's not included. We'll just continue reading just to see. 115, income of states, municipalities. 117, qualified scholarships. 118, contributions to corporations. Just stop the video for a second and keep reading. I'm just going to read these, right? 121, no. 122, 119, 123, no, right? We look to the next page. And if you read through all these, you're not going to find anything. There's right there. Certain military benefits. Maybe. So maybe we'll highlight that. 134 is certain military benefits because we know our person is in the military. Okay? And I would just start, if you read through 125, 126, 127, 129, 130, 131, 132 certain fringe benefits. I mean, maybe that. Again, it's possible. That one's very fraud. 135, no, it deals with savings bonds. 136, energy conservation, no. 137, adoption. 38, 139, 139A, 139B, nope. 139D, 139E, 139F, G, H, nope. 140, cross-references other acts. Cross-reference sections, by the way, they're not going to provide substantive stuff. So we've got 3 code sections to look at. We're going to start in order. So 112, and if 112 provides an answer, well, we're going to stop there. If not, 132 and then 134. Okay, so now let's go look at our code sections. And I'm going to go, and I'm actually going to start with section 61 because remember, that's where you start whenever you have gross income. So let's go look at that. So we know that it's an inflow. And if you weren't familiar with the structure of the tax law, you would see, hey, gross income. So is it income? Gross income means all income from whatever source derived, including but not limited to the following items. Compensation for services. Gives that as an example. So wages, which is what our fact pattern says, and if you want to stop and go back to the fact pattern, wages for services, including fees, commissions, fringe benefits, and similar items. So wages is part of that. Compensation for services, that's wages. That is what that is by nature. Okay? So we have section 61 gross income. So right now our answer is section 61 gross income. And if you put that, then you would be skipping steps. And that's why I've been stressing in these 3 videos the structure of the inclusions in income, and then you have to do part 3 with the exclusions. Then we go to part 3 and we look for exclusions. If there's an exclusion that applies, then it's not recorded, but if there's no exclusion, then it's going to be recorded as gross income. That is how the steps work. So let's now go to our list, our code sections under the exclusions we found, right? We found 3 of those, specifically section 112, right? We found that one first. Let's go that one. So section 112, certain combat zone compensation of members of the armed services. So we're looking at this, and enlisted personnel. Gross income does not include compensation. So that tax treatment rule does not include compensation received for active service members. For active service members. Okay? Let me change the color of the highlighting there. Active service members. Below the grade of commissioned officer in the armed forces of the United States Army for any month during any part of which such member served in a combat zone or was hospitalized as a result of wounds, disease, and so on. Now, a few things. Okay, so tax treatment rule, which remember is a general rule. Exclude. We exclude from income. Now, of course, again, section 101 to 140, almost surely the tax treatment rule will be exclude. So gross income does not include compensation, active service as a member. Okay, below the grade of commissioned officer. So that's non-commissioned officers. Talking about like sergeants. We're talking about grades below sergeant, but we're not talking about like lieutenants, captains, colonels, officers in the armed services. They do not get to exclude this amount. So we're talking about like private first class, or ensign, or depending on which service you're in. We're told in the facts that she's a staff sergeant, so she is not a commissioned officer, and therefore she would qualify. In the armed forces of the United States for any month during any part of which such member served in a combat zone. Okay, so combat zone, or hospitalized. Well, she's not hospitalized. Now, the next thing is to define a combat zone. Okay, they also talk about commissioned officers as well, in case there are, she was a commissioned officer. Definitions. So look for definitions, and we see the term combat zone means any area which the President of the United States by executive order designates for purposes of this section or corresponding provisions of prior income tax laws as an area in which armed forces of the United States are or have engaged in combat. Okay. So we're told that she's in the Iraq War. I mean, knowing history, that was a pretty, there was a lot of conflict going on there. So it seemed that would be a combat zone. Of course, you could look that up. There would be a list of which combat zones would be, online. You would find the Iraq War would be on there. For those of you taking my class, I would be more specific and tell you, that would be it was designated by the President of the United States. I wanted to keep it a little bit more broader because the client brings you these facts. So we just found that section 112A. So if I asked you for a subsection, it would be section 112, subsection A. Just like that, you'd write that out, right? Or just 112A, right? Because you don't want to do the section symbol necessarily. If I'm asking on the exam, that means that Sergeant G.I. Jane does not include. So she excludes the amount she received during the year, which was the 8 months of the compensation she received. She excludes it from gross income, and that is the result. That is the result under section 112A. So we don't cite the section 61 and 112A. We just cite simply the section 112A. Let's go on to the next question. Carol received a gift of stock from her favorite uncle. The stock had a fair market value of $30,000 basis to the uncle of $10,000 at the date of the gift. All right. I'm not going to go through all the steps we went through before. You can apply that. If you want to go back to the first problem and apply the 5 questions and the inflow versus outflow and all that stuff, that's fine. We will do inflow and outflow, of course, throughout the thing because that's very important. That's very, very important. So Carol received a gift. We're told that. So right there, boom, that's inflow. Carol received a gift of stock from her favorite uncle. The stock had a fair market value of $30,000. A basis to the uncle of $10,000 at the date of gift. You put a comma in there, or colon. Okay. Fair market value $30,000, basis to the uncle of $10,000, date of gift. So this is an inflow. So now what we're going to do, and we're actually told this is a gift. So we might actually want to use language. Sometimes the language we're told by clients, it might help us for tax law. Other times it won't. Okay, but this one, gift, that seems like it's a technical term, especially if you've ever you've learned a little bit about tax, that gifts are a thing. There's gift tax return, so that could be helpful. So now we're going to look through the through our table of contents, and again, we're looking at inflow, so we're dealing with income. We're dealing with income, and we're going to go through there. We're going to start at section 61, and then we're going to look to see if there's any possible exclusions as well. We're going to look through any exclusions as well. Okay, so let's go ahead and do that. So here's the beginning of table of contents. Let's go ahead and go down to subchapter B. Now that we've this is our second time doing this, we can kind of move a little faster. You can read all that stuff. That would be dealing with credits and calculation. We've got section 61, definition of gross income. And if you read that code section, which I'll go to that in a moment, you would see that somebody receiving a gift, just from a definition of gross income, that would meet the requirements. That would meet gross income. Now, it's not that clear, but under Glenshaw Glass, right, the accession of wealth, excession of wealth, I said to wealth, realization, and dominion control. You have all of those things. You can do whatever you want with she can do whatever she wants with the item. It's a realizations event because it's separate from the event that created it. Right? You can think of it like a service, like the transfer. So gifts of property, they're going to have severance, and then her assets have gone up with no corresponding increase in liabilities. So we have section 61, gross income. And if you're not sure about the Glenshaw Glass definition, you can still get to the answer by maybe doing a conservative approach, saying, well, maybe it is. So maybe I then go to part 3, the exclusions. So if we go to part 3, we then start reading the numbers and we see, hey, look at that. Section 102, gifts and inheritances. And if you read any other things in part 3, you wouldn't find anything that says gifts in the title. Now, many of you would stop there. But remember, this question, it's asking for any tax consequences. So if you did that, then that's a great job. But to be an outstanding job, you would need to go even further. Because if you keep going in the code, right? So we continue through subchapter, right? It's not deduction, so we skip over part 6, part 7, part 8, part 9 of subchapter B, and we move on. We're not dealing with subchapter C because we're not a corporation. We're not dealing with subchapter D because it's not deferred compensation. We're not dealing with subchapter E because it's not a when question. So this is not a when question. It's not really about, accounting period or method, as the title suggests. Subchapter F, exempt org. We're not dealing with organizations at all, so we can skip that. G, corporations. We're not a corporation. H, banking institutions. We're not a banking institution. I, natural resource. Not a natural resource. J, estate, trust, beneficiary, descent. I would probably start looking at or look through that to see if there's anything about gifts, and you don't really see anything. So I'll just, for the sake of time, you would probably stop the video, read through subchapter J. You're not going to find anything that applies to gifts. So you would go on. Again, the title, looking at the title. There might be something buried in those code sections, but we're just going by the titles here. Subchapter K, we're not a partnership. Subchapter L, insurance company, we're not that. Subchapter M, we're not a regulated investment company. Subchapter N, we're not dealing with income, international tax, income from sources within or without the United States. Subchapter O, let's go there. That's the next one. Subchapter O, gain or loss from disposition of property. So you might not think to come here, but let's just read the parts. Determination of amount of and recognition of gain or loss, and then basis rules. Look at that. 1015, basis of property acquired by gifts and transfers and trusts. Boom. So if you found the 61 and 102, that's a great job. I don't really expect, especially if you're that new in the tax area, that you would have continued. You probably would have stopped there. But if you found this, you did an outstanding job. And that's what is so important about in tax practice, that you continue to look for these things. You're going to see in later problems, we're going to be going further with these steps. So we have to look at these 3 code sections. Let's go ahead and take a look. All right, section 61, as I've gone through already, it's defined as gross income. Now, if you look through and you read these different things, none of the examples, like the previous one we saw with the wages, nothing says anything about gifts. It doesn't say, a gift is an example of something that's included. But if you go through our Glenshaw Glass definition, our 3 requirements, as I went through already, it meets section 61. So now we got to go to part 3 and look, hey, are there any exclusions, right? We're told specifically it is a gift, so we can go ahead and assume that. So here's section 102. Section 102, its title specifically says gifts and inheritances. General rule, gross income does not include, so that's our tax treatment rule, the value of property acquired by gift, bequest, devise, or inheritance. Now we're told in the problem that it is a gift. So indeed it was a gift. I'm telling you that. So tax treatment rule, we exclude gifts. We exclude other things as well, but specifically exclude gifts. So right there, section 102A would apply. Now we can read through just to be careful, be cautious. B, income. Subsection 8 is shall not exclude from gross income the income from any property. Well, she's not receiving any income. She's receiving the property outright. So subsection B does not apply if you continue reading. And then employee gift, subsection C, this is not an employee relationship. Nothing about the facts say it's an employee. So right there, we've got section 102, and that's what you would cite to say that it would be excluded. The receipt of this item would be excluded from gross income. But remember, so that's the great job. The outstanding job is to continue. So section 1015 deals with the basis of property acquired by gifts. Now, one giveaway in this problem would be I kind of gave you some of the facts with the fair market value and the basis to the uncle before the gift. This could give you kind of, if you're in my class, this is how I kind of give you some hints that you might need to cite an additional code section. Maybe something is needed. So section 1015, basis of property acquired by gifts and transfer and trust. A, gifts after December 31st, 1920. If property was acquired by gift after December 31st, 1920, which we're going to assume it was, the basis shall be the same as it would be in the hands of the donor, so the uncle's basis, or the last preceding owner by whom it was not acquired by gift, blah, 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 blah. And then it says later on that there's an exception, though, and here is the exception. It specifically says in the same subsection A, except that if such basis is greater than the fair market value of property at the time of gift, which that is not the case. And if you continue reading, there's nothing else in there. So that means that, okay, the answer to the question is twofold. For the inclusion issue, the answer is we exclude the amount from gross income under section 102A, and then also the adjusted basis that she takes, that Carol takes in this property, equals the uncle's carryover basis, what the uncle's basis was, equals the adjusted basis of the uncle, which if you go back to the facts, we're told is $10,000. So nothing is included in Carol's gross income on her tax return, or her 1040, and then in terms of keeping track of the basis, she takes, so Carol's adjusted basis going forward is the uncle's adjusted basis, which was $10,000. So we are done with that problem. All right, problem 3. Maria is an independent long-haul trucker. She receives a speeding ticket for $500, which she pays. So now we're switching from inflow to outflow. So outflow, really, you can have deduction or you can have credit. Now, with the credit issues, you will find credits. There's credits throughout the entire tax code, but mostly you're going to find them in subchapter A. Mostly in subchapter A. So you're just going to read through all those different ones if you've never gone through credits before. And you're going to read through the subchapter A credits. You can find credits outside of that area, outside of subchapter A. However, that's where almost all of them fall. So just keep that in mind when we look at our table of contents. So really it's deduction. Now remember deduction, if we're looking at deductions, we have to find an allowance provision. And we find an allowance provision, which we start with part 6 of the subchapter B, right, of the table of contents under subchapter B. And again, there's deductions elsewhere in the code, but that's where we start. You want to start with the more general stuff. So allowance, you want to start from allowance provision. And then if there's an allowance provision, then you need to make sure you look at the part 9 disallowances just in case. So if it is allowed under allowance provision, you also have to look at the disallowance provisions as well. Now let's just understand the facts a little bit more. Maria is an independent long-haul trucker. So independent, and she's a long-haul trucker. So that suggests that it's some type of business activity, right? She's trucking, independent person doing her own business. She receives a speeding ticket for $500, which she pays. So this could suggest maybe business, right? The big 3 activities. Remember the big 3, there's business, there's investment, and there's personal. It's most likely not personal, right? Because if you're doing trucking, long haul trucking, you're probably not doing it personally unless it was like some like, she's trucking like, her own property or something for some reason. So really it's down to business or investment. Okay, just so keep that in mind. Maybe we need more facts, but just keep that in mind. So let's go ahead and look at the table of contents now. So if you go through the table of contents, again, looking at the credit, you would go through subchapter A because that's where most of the credits are found. specifically part 4 and below that, okay? Part 4 is where a lot of them are found. So I want you to stop the video, read through all of these, okay? Take a second and read through all of these. All right. If you haven't read through all of them, and again, they're on the next page as well, they go all the way down, there's nothing you're going to find for credits. So no credit here. So then we go down to subchapter B. We're dealing with outflows, so we go down to part 6. We go down to part 6. Itemized deductions for individuals and corporations. Now, section 161, allowance of deductions. We remember that that just kind of gives us the general idea that you have to find an allowance and then you have to look at disallowances. 162 deals with trade or business expenses. Now, if you look at a lot of these other titles in part 6, part 7, and part 8, you're really just going to see that one. There's also section 212, expenses for production of income. That looks maybe promising. Part 8, corporation. She's not a corporation. We're not told. So let's go ahead and let's take a look at those specific provisions. Now, with this type of issue, I recommend starting with looking at the allowance provisions, because if you don't have an allowance provision or if you have some special rule in an allowance provision, there's no time wasting looking at disallowance provisions. So let's go ahead and do that. So here's section 162. That was the first on our list. We also had section 212. So section 162, there's a general rule. There shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business, including, and it lists salaries, traveling expense. That might suggest something, right? Rentals, that's not what we have, right? Charitable contributions in B, gifts accepted. So before we move on to that, I just want to make note that this might apply because this provision applies to a lot of general stuff. However, it's kind of like the same thing we've been doing earlier where you go through and maybe you make note of something. Maybe it applies, maybe it doesn't. You still kind of like question it. It's like, okay, well, maybe this is possible. But let's continue on because this code section still continues. So B, charitable contributions and gifts expected, no. Illegal bribes, kickback, other payments, no, that's not what it is. It's not a legal bribe or kickback. It's paying of a speeding fine. D, capital contributions to Federal National Mortgage Association, no. E, denial deduction for certain lobbying and political, no, it's not that. Keep going. Getting kind of long, right? But we keep reading. All right. F, fines, penalties, other amounts. Ooh, this looks interesting. In general, except as provided in the following paragraphs. So let's make sure we read that. No deduction otherwise allowable shall be allowed under this chapter. So chapter, so that's for income tax, for any amount paid or incurred, whether by suit, agreement, or otherwise, to or at the direction of a government or governmental entity in relation to the violation of any law or the investigation of inquiry of such government entity into the political violation of any law. This sounds like what we have here of Maria. Maria is paying a governmental agency a fine for speeding, right? The police or sheriff or whatever, okay? And then there's the paragraphs below, paragraph 2, exception for amounts constituting restitution or paid to come into compliance. That's not what we have here. You know, that'd be like if you're paying an amount to come into compliance, right? 3, exception for amounts paid or incurred as a result of certain court orders, no. Exception for taxes due, no. Treatment of governmental regulatory entities, no. And then treble damages is where you go to the next subsection. So right there, because the paragraphs don't apply, that means no deduction shall be allowed. So under section 162F, it's pretty clear Maria cannot take this speeding fine that she's paying to a governmental agency as a deduction. It's not deductible. Now, again, you normally look for an allowance provision and then disallowance, but this one is specifically telling us in the allowance provision of section 162, you can't take it, so you don't even need to go to the disallowance provisions. See how that works? All right, let's go on to the next question. All right, number 4. Julie loaned her friend Nathan $2,500. Nathan did not repay the debt and skipped town. Okay, so we have an outflow here. This one's a little bit more difficult to see because we're focusing on Julie. We're not focusing on Nathan, we're focusing on Julie. So I'm asking about Julie here. Julie, what's the consequences of Julie? If it was Nathan, that might be viewed as a gift, as an inflow issue, right? Possibly income. But Julie, we're looking at the outflow. So she loaned $2,500 to Nathan, and then Nathan's not repaying. Okay, bad Nathan, right? So the question outflow, can she get a deduction or credit? Okay, again, credit, you look at that subchapter A. Deduction, you look at the area we just looked at for the last question, and you look at the the disallowance provisions and make sure if there's an allowance provision. Now, what does this kind of seem like? It seems like it's a bad debt. A bad debt. Okay. Now, some of you might be like, how did I get that phrase? How did I get that terminology? Well, you got to kind of use some business lingo because remember, taxes are economic transactions. You got to think of it in like a business sense. What does it seem like? Right? You're loaning. Right? It's or you could think of it as a forgiven loan, or it's definitely a debt, right? Nathan owes $2,500, but then he doesn't pay. So that's a bad debt. It's a perfect example of bad debt. Forgiven loan or unpaid loan. Those are all phrases. I mean, sometimes you can go to a thesaurus and you might be able to put this stuff in, forgiven loans, unpaid loans. It might come up as bad debts on that, okay? Forgiven loan isn't always the same thing as is not always considered the same thing as bad debt, but you might get that from that, okay? So bad debt. And we talk about like bad debt expense, allowance for doubtful accounts, those types of things, but bad debt. So if we see any type of wording in here for forgiven loans, unpaid loans, bad debts, keep that in mind. And remember, we're focusing on outflows, not inflows, because we're looking at Julie. So let's go ahead and take a look. Okay, so here we have our table of contents, as always. And if you go through and you want to stop the video, look at the credits. There's nothing. You're not going to find any credits that relate to bad debts or loans or any types of issues, okay? And if you don't believe me, you see something that looks promising, like by a title, go look at that, okay? So then we go to deductions, and we're going to go to Part 6. And Part 6, we have itemized deductions for individuals and corporations. That's our starting point for deductions, right? That's our starting point. So we read through all of these, and right there, 166 bad debts. Now, is there anything else that looks promising if we read through the deductions in Part 6? Not really so much. Okay, not really so much. Now, I'm going to go ahead, because that says bad debts, I just want to see if there's anything in the items not deductible that's really that clear. We have personal family living expenses. Remember, that's important because this looks like it's a friend, a personal expense. So that's obviously important. But the general rule, if you went there and you looked at that, remember this one says, hey, personal family living, PFL, or personal living family, however you want to call it, right? General rule is that it's non-deductible unless you find a provision that allows for it. So we're dealing with a personal friend, right? So that looks like it's a personal possible expense. That's important to understand. Unless there's a provision. So if we have Section 166, we're good. Capitalization, no. Nothing in here in these disallowance rules looks like it deals specifically with bad debt or forgiven loans or whatnot. So let's go ahead and look at Section 166. And then it doesn't look like there's really anything. If Section 166 works, it looks like there's not really any disallowance provisions out there. You can read through all these. If you find one that would apply, then again, you can go ahead and take a look, but I'm telling you there's not. Okay, so here's Section 166. So we look at Section 166, bad debts. General rule, wholly worthless debts. There shall be allowed a deduction any debt, which becomes worthless within the taxable year. So we're told that she lent $2,500 to her friend Nathan, and now we're told Nathan's not going to pay it back. Partially worthless debts. Partially worthless debt is only when satisfied that a debt is recoverable only in part, the secretary may allow such debt in amount not in excess of the part charged off with the taxable year as a deduction. Now, we're told that she lent $2,500. We're not told that only part of the debt was repaid, so that doesn't really apply. Amount of deduction. For purposes of subsection A, the basis for determining the amount of deduction for any bad debt shall be the adjusted basis provided in Section 1011. Well, if you go to Section 1011 and this does apply, you're going to see, well, it's just $2,500 cash, so it would just be $2,500. So you can go to that. I'm just kind of saving you the time there. D, non-business debts. Hey, it looks like what we have here. So we have the general rule, wholly worthless debts, number 1, which seemed like it applied, but then we have non-business debts, so a special rule for non-business debts. And that's what we have here. General rule, in the case of a taxpayer other than corporation, hey, that's what we have. That's our taxpayer. A, subsection A, shall not apply to any non-business debt, and where any non-business debt becomes worthless in the taxable year, the loss resulting therefrom shall be considered a loss from the sale or exchange during the taxable year of a capital asset held for not more than 1 year. So it's saying that in subsection A, in the case of a taxpayer other than a corporation, subsection A shall not apply to any non-business debt. and where any non-business debt becomes worthless, the loss resulting shall be considered a loss from the sale or exchange during the taxable year of a capital asset. So this is kind of hard to understand, but what it's saying is that the general rule of subsection A does not apply to non-business debts, and then you apply this rule, where any non-business debt becomes worthless. That means entirely worthless. Within the taxable year, the loss resulting therefrom shall be considered a loss from the sale or exchange during the year of a capital asset held from not more than 1 year. So that means a short-term capital loss. That's what that means, STCL, short-term capital loss. And it defines what a non-business debt is. For purposes of paragraph 1, the term non-business debt means a debt other than a debt created or acquired in connection with trade or business, or, which was what she has, or, so the or language, a debt, the loss from worthlessness of which is incurred in the taxpayer's trade or business. So what we have here in this situation is a non-business debt because that's here. It's not a trade or business. She's loaning her friend Nathan money, and then the entire amount becomes worthless. So we have this. So the entire $2,500, all $2,500 allows a deduction on her return as a short-term capital loss. And the code section that provides that is section 166D, because you need both of these rules. You need this rule and you need this rule, so you would cite to section 166D. All right, again, you would look down for any disallowance rules, but I've already gone through and done that for you, and the answer was no, so therefore it's going to be allowed on the tax return as, again, a $2,500 short-term capital loss deduction. Let's go on to the next question. All right, so moving on to number 5. Juan sold IBM stock to Richard for a $10,000 loss. Richard is the current husband of Juan's sister, Carla. Okay, anytime that you see a loss is going to denote outflow. Gain will denote inflow, right? That's what we think of economically. Think again economically. So we're dealing with outflow here of a $10,000 loss. So Juan sold IBM stock to Richard for a $10,000 loss. Richard is the current husband of Juan's sister, Carla. Okay? So we have to look, and we're looking at for deductions and credits. Again, credits, same thing as last one, and deduction, we do the same thing. Okay? So we're looking for rules that apply to losses, trying to find a deduction possible for losses or credit, and then any disallowance provisions or any special rules. Let's go ahead and do that. So we go through our code. Again, we start subchapter A looking for credits. We don't find anything. If you want to stop and look through, go ahead. You're not going to find anything there. I'm just trying for the sake of time. You really should go through and look at that. So we go to subchapter B. We skip part 1, part 2, part 3 because we're not dealing with inflows. We're dealing with outflows. Part 4, part 5, also, we don't look at those as well because they don't apply. Part 6. So right here, losses. We have a loss in the problem, and we have right here, boom, section 165, losses. Now, if you look through other things, you don't really see anything else about losses per se. So again, we're trying to start off because we're going to the most basic level here if you're starting off in tax research. We also have to consider the items not deductible under Part 9. Right here it says losses, 267, losses, expenses, and interest with respect to transactions between related parties. Okay, so let's go ahead and take a look at those two code sections. So section 165 says there shall be allowed as a deduction any loss sustained during the taxable year and not compensated for by insurance or otherwise. But then it says there's a limitation on losses of individuals, which we do have an individual here. In the case of an individual, the deduction or subsection A shall be limited to losses incurred in trade or business, losses incurred in any transaction entered into for profit, though not connected in trade or business, and then if it's a personal loss, only if it arises in storm, shipwreck, theft, or other casualty. Now we're told in the problem that the loss, the $10,000 loss, came from the sale of stock, specifically of stock. Now, when people think of stock transactions, usually stock is going to be investment activities. That's what this is right here. So it's an investment loss. Investment activity. It says it is allowed. Losses incurred in connection entered into for profit, though not connected with a trade or business. Now, it may be limited, but we do know it's allowed. If it was personal, it would not be, right? That's personal use. That's like, if you're selling your personal residence, right? There's not investment activity going on. There's not trade or business. But if you own stock, it's either going to be investment or business, and usually it's investment because you're most likely not a dealer or a trader of securities. Now, one thing to note is that he did sell his stock to his brother-in-law, so keep that in mind. So right now, under section 165A, it can be deducted. That's the rule that grants it, right? 165C2 provides the special rule there, but 165 says you can take the deduction, and then C2 says that, hey, investment losses are allowed. So keep that in mind, all right? Let's go on now. Now that we have this, we have to ask, hey, part 9, my apologies, part 9, are there any disallowance provisions? Because right now, it would be allowed as a deduction. So are there any disallowance provisions? Let's go ahead and consider that. So section 267, we came across losses, expenses, and interest with respect to transactions between related parties. So related parties, we don't even really know what that is in general, but we know that we're dealing with losses. So this kind of is important to consider. Deduction for losses disallowed. No deduction shall be allowed, so it's a disallowance rule, in respect of any loss from the sale or exchange of property, that's what we have, right, sale or exchange of stock, directly or indirectly, between persons specified in any of paragraphs of subsection B. The preceding sentence shall not apply to any of the loss of distributing corporations or distributee, or in the case of any distribution and complete liquidation. Okay, so now we got to go down to B. We have to go to B, and B says relationships. The persons referred to in subsection A are members of family and as defined in C4. Well, we've got a brothers-in-law, right? Brothers-in-law, they are selling this stock between one another, and then the question is whether he can take a loss, even though he's selling this loss to a brother-in-law. So then we have to go down to C4. So we go down to C4. Let's find C4. And we need to determine what family member is. So the family of an individual shall include only his brothers and sisters, spouse, ancestors, and lineal descendants. So that doesn't look good because it specifically says brothers and sisters. Okay, we need to see if there's anything that deals with in-laws. Let's see if we can find anything that deals specifically with in-laws, all right? Well, this is an example of where you need to really read the language. Read this part after brothers and sisters, whether by the whole or half blood. So whole blood, of course, is both of your parents are the same parents, your mother and father are the same, and then half blood is one of your parents are the same, whether it's your mother or father is the same. But nothing in there does it say anything beyond whole or half blood. So that means that by in-law or by marriage, that doesn't count. So because it specifically states that, in-laws are not part of that. So section 267 does not apply. So we're back at section 165A. Now, in section 165A, if you continue reading section 165, it references section 1211. It says that with respect to certain losses, you have to consider the rules of section 1211. So we have to go there, okay? And I want you to stop the video and go back to section 165 and read that. Read that part down below. I'm not going to go back. I'm just going to say that it does say that. It references section 1211 with capital in terms of characterization. Because if you remember, right, the 5 questions, we're dealing with what amount is deductible or credit, right? What amount can you deduct or credit? And there's also the who is, of course, we're focusing specifically on Carlos. The when is, of course, this year. So those are all answered, and we know we can deduct. But what about the character? Well, character is an important question, and it's important here, especially because section 1211 is brought up. So let's go over there. So under section 1211, we're told that because this transaction, if you think about it, the sale of stock generally is viewed as a capital asset. If you look at section 1221, 1222, and 1223, you're going to see that it results in a capital loss of $10,000. Specifically, if it's more than a year, it'd be a long-term capital loss. If it's a year or less, short-term capital loss. So let's assume it's been held for more than a year, so it's a long-term capital loss. So that means that Carlos can only take $3,000 of the capital loss, not the whole $10,000 on his tax return. And that's very important. So the answer would be section 165A is the correct answer, but for the outstanding answer, you would note that, hey, not all $10,000 can actually be taken on the tax return because section 1211B specifically says that, hey, only $3,000 on Carlos's return or Carlos married filing joint's return can be taken. Or if married filing separate, it would be $1,500, but that's, of course, much more rare than filing joint or single return, okay? So $3,000 of it, and then the remaining $7,000 gets carried forward, as it says in section 1211. Okay, it says that gets carried forward if you continue reading in this provision. I'm sorry, actually in 1212 it specifically talks about the capital loss carrybacks and carryovers, but this year only $3,000 can be taken. So that is question 5. All right, question 6. On May 1st, Rick formed a new corporation. Got a corporation. Red Inc. He spent $3,000 in legal fees and paid the state $600 in incorporation fees. Okay, so we're now dealing with a corporation, and now we get to have some fun with corporations. Now, thinking, you've already done all these problems, and thinking back to the videos you've watched before in the table of contents, you know that certain areas of the tax law involve corporations. And that's what you need to focus on in this problem. If I specifically tell you as a corporation, more likely than not, there's a chance that the question relates specifically to something that applies to corporations specifically, a special rule. So we're talking about legal fees paid and estate and corporation fees to form a new corporation. So let's go ahead and let's look through the table of contents. And we're also going to note areas of the code that deal specifically with corporations. All right, so let's look here. We've got subchapter C, corporate distributions and adjustments. We also have subchapter S, dealing with S corporations. Now, we don't know if it's an S corporation, but still. Now, remember also that subchapter B applies to all taxpayers, and there is some special rules that deal with corporations there. So let's go ahead and look at those things. It's also important to note that since we're dealing with expenses, we have outflows. So we're focusing on outflows for, again, legal fees and organization startup fees that you pay to the state filing fees, those kinds of things. So let's go ahead and look. And there's also credits in section 1 through 59B. And again, you can take a look at that, but I'm going to go ahead and save you some time. Please read through it. You're not going to find anything in there about corporate, those types of fees for corporations. All right. So we go down to subchapter B, and I'm just specific, again, start out. Of course, you have the entire Internal Revenue Code, so you want to kind of start with the areas that focus specifically on corporations. And if we go to subchapter B, which is where we're at right now, and we go to part 8. Part 7 is for individuals. Part 8, special deductions for corporations. We're going to go ahead and we're going to note that area, okay? We also know that subchapter C and subchapter S of the income tax area, they also deal with corporations. Let's just read some of these because, look, deduction. So outflow, right? Good. So 241, allowance of special deductions. 243, dividends received by corporation. We don't have a dividend. 245, dividends received. 245, deduction for foreign source portion. No. 246, rules applying to deductions for dividends received. No. 246A, dividends received. No. 247, contributions to Alaska. No. 248, organizational expenditures. That seems interesting. Organizational expenditures, so that could be to organize the business. Let's go ahead and look at that. If we don't see anything that applies, we would then go to subchapter C and subchapter S. Let's go ahead and take a look at section 248. So we read section 248, organizational expenditures, election to deduct. If a corporation elects the application of this section, so it's an election, that's important to note. That's one thing, that's a tax theme. Not one that I really stressed, but there's certain code sections you have to elect. So you have to elect into it, unless you don't want the section to apply, and then you wouldn't elect. If a corporation elects, so we have a corporation, right? That's our corporation, red. The application of this subsection in accordance with regulations with respect to any organizational expenditures, which maybe there's a definition of that, the corporation shall be allowed a deduction for the taxable year in which the corporation begins business an amount equal to the lesser of the organizational expenditures or $5,000 reduced but not below zero by the by which such organizational expenditures exceed $50,000, and remaining such organizational expenditures shall be allowed as a deduction ratably over a 180-month period, which is 15 years, beginning with the month in which the corporation begins business. Wow, that sounds a lot like what we're doing, because these expenses were meant to start the business, and it talks about begin business. So now it makes me feel even better. Organizational expenditure is defined. The term organizational expenditures means any expenditure which is incident to the creation of a corporation. So it's required to start the corporation, is chargeable to capital account, and is of a character which, if expended to incident to the creation of a corporation having limited life, will be amortizable over such life. So you need all three of these. We have and language. So all three of these things. So paying, the real key here is the incident. You're paying these fees. The organization, these legal fees and the state filing fees. Do you need to pay the state filing fees in order to be a corporation? Yes. So we have incident. Is it chargeable to capital account? So does it go to capital, right? You have, you look at a corporation's balance sheet, you've got assets equal liabilities plus stockholders' equity. So we're talking about the stockholders' equity. Does it go on there? Yes. It goes out of the stockholders' equity. It affects both sides of the transaction, the assets and the stockholders' equity there. So therefore, or it could affect a liability as well, right? Could be a liability. So therefore, it's going to be, that does affect the capital account, and then it would be amortized over the life as an intangible asset for these filing fees or whatnot. So therefore, the filing fees are met. Legal fees will be the same thing. You got to pay to have your articles of incorporation, organization, they have to be created. If you don't have that, you're not going to be able to have a corporation, and paying legal fees is needed for that. So therefore, Section 248 does apply to this. Section 248 does apply to this transaction. Now, so you go to Section 248A, A1A, and you'd be able to take the entire $3,000. Because it says you get to $5,000. So all $3,000 would be able to be deducted under 248A1A. And the reason why it's A is because it's the lesser of this, which is $3,000 or $5,000. So it wouldn't be B, it'd be A. So this is an example for those of you taking my class. If you put 248A1B, that would be wrong. If you put 248A1B, that would be incorrect. So you got to be very careful. And again, this is very important because when you're doing tax research, guess what? This makes a big difference, because when people are reading your sources and they want to go back and reference that, and if they're looking at this section, they're saying, well, what do you mean B? It's, it says the lesser of, and you have $3,000, so 3,000 is less, and you obviously don't want to look like lose credibility in that issue. So really important. The only other thing to do would be to go through the different Part 9 disallowance rules, and you would not find any. If you want to stop the video and take a look, you would not find any, but that would be the answer. So all $3,000 is deductible under 248A1A. Let's go on to the next one. All right, number 7. In December of the previous tax year, Ann's 12-year-old cousin Susan came to live with her after Susan's parents met a sudden death in a car accident. In the current tax year, Ann provided all normal support, example, food, clothing, education, for Susan, and did not formally adopt Susan. Susan lived in the household for the entire year. Okay, so this question, we're not really told any specific amounts. We're just told that she provided all our support. So, of course, you're probably thinking outflow. But something this general, this is more of a special issue, more of a classification issue, which, of course, many of you know in the tax law, classification makes a big difference. So this one I'm going to be very short with, because honestly, this is just a question where if you go through and you read the table of contents, just starting from the beginning, you would probably find the answer, but you would have to just continue reading. Now, I put the solution, kind of towards the top. I made this one kind of like closer to the top of it, so it makes it a little bit easier. But honestly, that's really all you can do. I would recommend that you want to focus on, we're talking about individuals. So, of course, you would want to look at the areas of the subchapter where individual taxation is relevant, and then just start reading, okay? So let's go ahead and take a look. And we're looking for special classification rules, if anything listed in the table of contents. Okay, so looking at the subchapters, we're looking for ones that deal with individuals, and really subchapter A and B come to mind. There's some other areas as well, right? There's characterization, and there's timing, issues like that. But let's just start with subchapter A and B and just go on from there. So subchapter A, we got tax on individuals, tax imposed definitions. You might find something there, right? We can note it, put a question mark. We're not taxed on corporation credits. You might find something there, like child tax credit. Again, put a question, because that's more, we're looking for more of a classification type item that you might see there. Adoption expenses, that might be questionable as well. You know, what is the tax law defined as adoption? Maybe she falls within that. Business, it won't be a business credit, so we can continue on. It's not an investment credit. So then we go on to definition of gross income. Well, we're dealing with really outflows here because she's paying for expenses, so it's not any part 1, part 2, or part 3. Also, part 4, tax exemption requirements for state and local bonds. No. Look at part 5, deduction for personal exemptions, and it talks about allowance of deduction for personal exemption. Well, personal exemptions currently aren't allowed in the tax law. I mean, they were at one point, so I wouldn't really go there. Look at 152, dependent defined. That looks very promising, so let's go there. So let's go ahead and take a look at 152, and then if there's nothing else, I would just go back to kind of the areas you found and maybe continue looking at table of contents in subchapter B to see if there's anything else with the expenses, maybe looking at the individual deductions such as medical, dental, those things, other expenses that that's one I see, tuition maybe, things like that. Those are really the only ones I see so far, but that's where you'd probably continue, is looking through those items but 152 seems very promising. Let's go ahead and take a look at that. All right, section 152, dependent defined. In general, for purposes of this subtitle, so the entire subtitle, the term dependent means 1, a qualifying child, or 2, a qualifying relative. So it could be either a qualifying child or qualifying relative. Now, it's not really a child per se, right? But it's more of a relative. But it could be a child depending on how it's defined. So exceptions. For purposes of this section, dependents ineligible. If an individual is independent of a taxpayer for any taxable year of such taxpayer beginning in a calendar year, such individual shall be treated as having no dependents for any taxable year. That's not what we have, because our person's not. They're not married, not citizens or nationals of other countries. Exception for adoption child. We don't have anything about being adopted. Qualifying child C. For purposes of this section, in general, the term qualifying child means, with respect to any taxpayer for any taxable year, an individual who bears a relationship to the taxpayer described in paragraph 2, so we're going to look there, who has the same principal place of abode as the taxpayer for more than one half of the year, looks promising, who meets the age requirements of paragraph 3, who has not provided over half of the support of individual's own support for the calendar year, again, promising, right? Who has not filed a joint return. Relationship, the relationship test. So, for purposes of 1A, individual bears a relationship to the taxpayer described in this paragraph if such individual is a child of the taxpayer or descendant of such child, or brother, sister, stepbrother, or stepsister of the taxpayer or descendant of any such relative. So, unfortunately, it does not look like she's going to qualify for the child, the qualifying child, because this is what qualifies. A qualifying child, taxpayer, or descendant of such a child, so you're talking about grandchildren or great-grandchildren, brother, not brother, sister, not stepbrother, not stepsister, none of those, or any descendant of such relatives. Well, those will be nieces and nephews, okay? And she is a cousin. So, unfortunately, that's not listed. So, it looks like she's not considered a qualifying child. If we go back, remember, qualifying child or qualifying relative. So she doesn't meet qualifying child. Let's look at qualifying relative. So qualifying relative is defined in D. So we can stop there, because if you look at the tests, right, for qualifying child, you needed all those things. And we fail bear relationship. So the relationship test fails. So we fail one of the, you need all those requirements. It's not going to be a qualifying child. So now we go down to D. Okay. Now we go down qualifying relative. For purposes of this section, in general, the term qualifying relative means with respect to any taxpayer for a taxable year who bears a relationship under paragraph 2, for whose gross income in taxable year is less than the exemption, which we're told no gross income, with respect to whom the taxpayer provides over one half all supports provided, and is not a qualifying child of any other taxpayer during the year. And she can't be for the parents, because the parents have died, they can't claim her, and they're not providing. So unfortunately, the parents are not going to be able to claim her because they died in a horrific accident. So relationship. Now you're going to see the relationship is going to be broader. Child or descendant of child, brother, sister, stepbrother or stepsister, father, mother, or ancestor of either, stepfather or stepmother, a son or daughter of the taxpayer, a brother or sister of the father or mother of the taxpayer, a son-in-law, daughter-in-law, father-in-law, an individual who, for the taxable year, the taxpayer has the same principal place of abode, entire. Okay? So that's important right there. At any time, so it's the entire. So if you go through the relationship tests, she's not a child or descendant of a child. Brother's not a stepsister, not father, mother, descendant, not a stepmother, stepfather. So it's a little bit broader, but still not there. Not a son or daughter, brother or sister of the taxpayer, brother or sister of the father or mother of the taxpayer. That would be aunt or uncle. It's not a son-in-law, daughter-in-law, so it's not that. But she does meet this because she was there all year. So the relationship test is met. Gross income, there's no so we have relationship. There's no gross income. She does provide more than half the support. And again, she's not a qualifying child. So we meet all three. So therefore, the answer would be that she is a dependent under qualifying relative test under 152 D. Those items. D2H specifically is where the issue lies, and she's there for the entire year, which we're told in the fact pattern. So if I was asking for a reference to this, I would specifically, I guess you would be, you could specifically cite to either 152. I might ask for the specific where the issue lied, and that was that specific site, 152 D2H, or it'd be right here, 152 A2 qualifying relative. Let's go on to the next question. All right, question 8. So question 8, Help the Homeless Inc. has been granted federal tax exempt status. The main activities of the organization deal with the feeding and providing shelter for certain homeless individuals. The facility is located right next to State University Football Stadium, which seats well over 80,000 people. During game days, the facility provides parking for the football games at $50 per space. It raises well over $10,000. Okay. This is another special question. You got to really pay attention to the facts here. So we're told that Help the Homeless Inc. is federal tax exempt status. Now, going through the table of contents by now and understanding tax law a little bit more, having gone through the video, right, and you've watched my other videos, there's an area, subchapter F, right? Subchapter F deals with tax exempt. So that's probably the best place to look, right? Subchapter F. Now, you have to kind of, so you're saying, okay, well, this question's easy then. I just go to subchapter F and found the answer. You really got to understand what's going on economically. We know the normal activities, the main activities are feeding and providing shelter for the homeless. But it says that on certain days, because they're right next to the stadium. That's where their location, their facility is located, next to the stadium. They provide, they sell parking spaces to people for $50 per space, which is not their main activity. That is another activity. Another activity, okay? It's not their main activity. And if they've been provided federal tax exempt status for providing shelter and food for the homeless, this might not be considered federal tax exempt. So there might be some issue where a tax exempt entity may have to pay tax on certain activities but not other activities. And that's kind of what we're raising here. So the best thing to do is to start with subchapter F and kind of read through and see if there's anything related to that issue. If there's like partial taxation, okay? All right, so here is our table of contents as we've been using. Again, subchapter F deals with exempt orgs. So even if you didn't know that, if you didn't watch other videos or forgot that, you could see exempt orgs. So let's go ahead and look at subchapter F. And again, what we're looking at here, if you think about what's going on, right, their normal activity is providing food and shelter to the homeless. And that seems like something that you would be provided with tax exempt status. But then they're also selling parking spaces because they're right across the street from the huge football stadium. If you've ever been to College Town on game day, parking is insane. And you can make some big bucks being right next door. And that seems like that might be not necessarily what they got tax exempt status for. So part 1, general rule, exemption, feeder organizations, requirements for exemption. So maybe 503, we'll put a little question mark there. 504, status after organization ceases to qualify for exemption under Section 501 because of substantial lobbying. That's not it. 505, additional requirements for organization described in paragraph 9. That might be because we don't know what that is. 506, organizations required to notify secretary of intent to operate under 501c4. Maybe. Private foundations. We're not a private foundation, so we're told we're a tax-exempt org. Termination of private foundation, special rules, private foundation defined. We're not told anything about private foundations, so we can skip that. Part 3, taxation of business income of certain exempt orgs. That sounds very interesting because, again, it seems like maybe they're doing something unrelated to their main business. So 501, imposition of tax on unrelated business income. That sounds interesting. Of charitable, etc. organizations. Well, our organization seems charitable, right? They're providing services for the homeless. 512, unrelated business taxable income. 513, unrelated trade or business. 514 is debt finance, and 515 is taxes of foreign countries. Let's go ahead and take a look at these three, 511 through 513, because 514 and 515 don't really relate to our area. If you read through the other parts, part 4, part 5, part 6, part 7, part 8, you wouldn't really see anything applies. So we can go ahead and we can take a look at these three things. I think these three things seem the most likely to apply, so we'll do that before we do our question marks. Let's go ahead and look at 511 and then 512 and 513. So here's section 511. It says imposition of tax on unrelated business of charitable organizations. Subsection A, charitable, etc. organizations taxable at corporation rates. Imposition of tax. There is hereby imposed for each taxable year on the unrelated business taxable income, as defined in section 512 of every organization described in paragraph 2, a tax computed as provided in section 11. In making such computation for this section, the term taxable income as used in section 11 shall be read as unrelated business taxable income. Okay, so it looks like sections 511 kind of leads a tax on tax-exempt entities for certain unrelated business taxable income. 512 then defines it. Definition, for purposes of this title, general rule. Except as otherwise provided in this subsection, the term unrelated business taxable income means the gross income derived by any organization from any unrelated trade or business, as defined in section 513, so we got to go there, regularly carried on by it, less the deductions allowed by this chapter, which are directly connected with the carrying on of such trade or business, both computed with the modifications provided in subsection B. So now we need to go to section 513 because we need to see unrelated trade or business. So 513, unrelated trade or business. General rule. The term unrelated trade or business means, in the case of any organization subject to the tax imposed by subsection 511, the one we saw just before, any trade or business, the conduct of which is not substantially related, aside from the need of such organization for income or funds, or the use that it makes of profits derived, to the exercise or performance by organization of its charitable, educational, or other purpose of functioning constituting the basis for its exemption under section 501, except that such term does not include trade or business, blah, 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 blah. So right there, boom, it looks like this is exactly what we have, right? Tax-exempt status is granted to the main activity, providing homeless shelter and food, which that seems like a charitable cause. But then you've got sections 511 and 513 that would apply potentially to this income that's being generated from the parking, which is not related to the homeless, right? Again, feeding the homeless, which is completely unconnected. Therefore, sections 511, 512, 513 more likely than not apply, and that would be the code sections that you would need to cite for this specific example. Let's go ahead and move on. Okay, question 9. Tex is a rancher. This year, her herd of cattle was infested with hoof and mouth disease and had to be destroyed. Tex's insurance policy reimburses her for an amount in excess of the tax basis in the cattle, thereby creating an insurance gain. After receiving the insurance proceeds, Tex buys a new herd of cattle. Okay, so this question has property transactions all written all over it. We have property, right? Property under the tax law is broad. So property equals broad, as the courts have determined. It's been interpreted by case law, by the courts. Property has been defined broadly. I talked about that in my other videos, okay? So basically, cattle, it potentially is it's property, okay? Think about it like your inventory, or what, if you're dealing with selling for meat or whatever. Infested with hoof and mouth and had to be destroyed. So, okay, property is destroyed. Insurance policy, receive insurance. And then after the insurance proceeds, Tex buys a new herd of cattle. So the starting point always when it comes to property is section 1001, which is the beginning of subchapter O. Okay? Now the idea here is that Tex received an inflow of money. Okay? Tex's insurance policy reimbursed in excess for an amount in excess of the basis of cattle. So what we're saying is when we look at section 1001, which we're going to pull up in subchapter O, as you know, or if you don't, you should definitely learn this. This is one of these things that you should probably memorize. It's so important in tax. Amount realized minus adjusted basis is what section 1001 deals with. So the insurance gain here, or the proceeds would be the amount realized. That's what Tex receives. And the adjusted basis would be the adjusted basis of the herd. And it's saying that there's an excess, so sorry, I misspelled that, right? Herd, H-E-R-D, not H-E-A-R-D. There will be a gain because it's saying that the insurance proceeds are in excess of the herd's basis, the basis of the herd. So there is indeed a gain. So the question becomes, will this gain be recognized? Okay, will this gain be recognized? So let's go ahead. We're going to go into our table of contents, go right to subchapter O, and we're going to take a look. Now, we're not going to really focus on the characterization, although that would be important. But we're just going to really focus on the specifically because we're talking about the insurance proceeds and the excess, the way the question is labeled. But, you could obviously go into characterization components. You could go into determining, I think you would need more facts here, but you could determine, hey, is this inventory? Is it capital? Those are things you could consider as well. So I'm not saying that that's not something to raise. I'm just not going to bring that up just for the sake of time. The character question, we're going to ignore for this problem. But if I asked you on the exam, I would ask you specifically, okay, character or property, I'd say specifically those things, okay? I'd make it more clear. But character could be considered. I would say for the character, though, you need more information, more info, because we don't know if it's going to be inventory. It depends on what's going on and how the cattle is held. That's something that's very important. I probably would say it'd be inventory and therefore ordinary, but again, you never know. So let's go ahead. Let's take a look in section 1001 and the table of contents, and we're looking at recognition. Let's consider our rules from that when we go through these elements of property transactions. Okay, here is our table of contents. We're going to go right to subchapter O. And by the way, going to subchapter O, the way we did that, if you're still unsure how I did that, you're saying, oh, he jumped too many steps, please go back over the top 100 tax code section video, as well as the tax themes video, as well as the beginning of this. I talk about many of these themes when it comes to property transactions, and you should be able to spot that. Property is very broad. And when you're talking about, insurance proceeds, receiving insurance proceeds as a result of events, you got to always consider property transactions some of those most important rules in the entire tax law. And that's how I know to go right there, is because property, anytime you have property, whether it's a sale, exchange, destruction, involuntary conversion, you got to consider that. You got to consider property, okay? So subchapter O. So right there, section 1001, we've already done that, and we talked about it. And if you didn't know amount realized minus adjusted basis, you can find that there. It's defined in section 1001A. It's just one of those things that's so important. I highly recommend you learn that. I don't care if it's flashcards, whatever. Okay. Now also remember, we talked about this earlier, that all gains and losses are recognized unless there's a special rule. So 1001C, that gain would be recognized unless we can find a special rule. So there's non-recognition rules throughout the entire tax law, but some of the most common ones are found here. And you'll see specifically 1031, like-kind exchanges. That's possible. The only problem is that we looked at that earlier and it dealt only with real property, so it can't be that. So you might be thinking that. Okay, because her cattle were destroyed by that disease, and then she received insurance, and then she bought them. Involuntary conversions is another very popular one, and this might be possible. Now, involuntary conversions, you're like, well, how did you get that from that title? Involuntary conversions just mean that events that are not voluntary. So this was not voluntary. The disease was not was not requested. It was not wanted. It happened. So let's go there and look at that. Okay, so here's our section 1001. We've already done this. So again, section 1001, the amount realized minus adjusted basis, that's all discussed here in this area right here. Okay, so that's where you'd find the amount realized minus adjusted basis. Okay, and then 1001C, that's where you're going to find the recognized gain or loss calculation. The general rule that realized gains and losses will be recognized unless you find a special rule. Okay, it says except as otherwise provided in this subtitle. Okay, let me use a different color to show you that. Except as otherwise provided in this subtitle. So subtitle, of course, being big. So you have to find a special non-recognition rule. And we're going to do just that. And we have one that we want to look at. That's section 1033. So section 1033 deals with involuntary conversions. And it says that in general, the general rule is if property, as a result of destruction, hey, we had destruction in whole or part, theft, seizure, requisition, or condemnation, or threat or imminence thereof, is compulsory or involuntarily converted. And it talks about conversion in similar property, conversion to money, which is what we had, right, due to insurance. And then the gain shall be recognized except to the extent hereinafter provided in this paragraph, non-recognition of gain. If a taxpayer during the period specified for purposes, blah, 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 so converted, purchases other property similar, that's what we have, right? We have destruction of the cows and we buy others, or related in service or use of the property so converted, or purchases stock, we don't have that, at the election of the taxpayer, so you have to elect. This is the election rule. The gain shall be recognized only to the extent the amount realized upon such conversion exceeds the cost of such other property or such stock. Okay? Such election shall be made at the time and manner of secretary regulations. And it says, continue the period by which the property must be replaced. So you have to replace it within a certain period of time. General rule is 2 years after the close of the first taxable year in which any gain, all that good stuff. But what about property? Do we know if cattle qualify? And if we come down here, the basis rule, remember every non-recognition rule is a basis rule, but I just want to see if cattle apply, if cattle can apply to this rule. So D, livestock destroyed by disease. For purposes of this subtitle, if livestock are destroyed by or on account of disease, or are sold or exchanged because of disease, which is exactly what we have, such destruction or such sale or exchange shall be treated as an involuntary conversion to which this section applies. Boom. That would be the section you want to cite, 1033D, because that one is the most specific. So that's one thing for those of you that are in my class watching this. It's important to understand that if there's multiple code sections that you think you can reference the code section that's the most specific to our fact pattern, which would be this one. Of course, the general rule is what applies to given non-recognition, but what I'm looking for is 1033D because it says it deals specifically with livestock or disease. I write these fact patterns a lot of times with this kind of direction in mind. I want you to get as down into the details as possible. And that's really everything for this one. So potentially, this taxpayer can can qualify for section 1033 as long as we'd have to look at how long the replacement period was, which we learned 2 years, right? But you need to look at more detail. But really, you see that potentially they can qualify. Let's go to our last scenario. All right, 10. Betty owed Martha $5,000. In payment of this debt, Betty transferred to Martha a life insurance policy on Betty with a cash surrender value of $5,000. The face value of the policy is $100,000. Martha names herself as a beneficiary of the policy and continues to make the premium payments. After Martha has $15,000 in premiums, Betty dies and Martha collects $100,000. Okay, so we're looking at Martha when she collects the $100,000, whether that... So I'd have to, obviously, on an exam, be more specific because a lot of stuff's going on here. I would say what code section would apply to that specific transaction. Now, again, Martha's receiving $100,000. So we have an inflow of $100,000. So remember, the question is, do we include or do we exclude? So let's go ahead and break down these facts in more detail. We've got some key terms here. We have life insurance. And then it looks like there's a transfer. So Betty owed Martha $5,000. In payment of this debt, Betty transferred to Martha a life insurance policy on Betty. So basically, so you have to kind of think. This question it helps you understand there's a lot of stuff going on. There's a lot of events. And the best way I like to do this is draw a timeline, right? A timeline over time. We don't know what years stuff happened. But first thing we know is that Betty owes Martha $5,000. Okay, Betty owes Martha $5,000. Okay, next time, let me change, next event we're told. So to pay off that, Betty gives life insurance, LI, contract to Martha. So basically, Betty at some point owned a life insurance contract on herself, which I'm assuming she probably paid to, one of her beneficiaries, whoever she designated. She's now basically saying, hey, I'm going to transfer that over to you, and I'm basically going to make you my beneficiary. That's basically what's going on. Okay, and it has a face value at the time of transfer of $5,000. The idea is, maybe the value at that time, the amount put into it is $5,000. That's what it would be if it was transferred. So basically, the debt is now gone. So the value of the policy is $100,000. So on Betty's death, Martha's going to get $100,000, which is what happens on death. So then Martha names herself as a beneficiary in the policy and to collect the premiums. After Martha has paid $15,000 in premiums, okay, so Martha over time pays $15,000 in premiums. So she takes on this policy. So Martha pays. So when Martha received this transfer, it had a $5,000 cash surrender value. My apologies. Cash surrender value. Let me take that off. The face value of the life insurance is $100,000 on Betty's death. On Betty's death. So surrender value, meaning if Martha was to switch it, to the bank or somebody or another party, they could get $5,000 for it. So that's what that $5,000 is here. And then over time, Martha pays $15,000 in premiums because you have to continue to pay the premiums. And then we've got the event. Betty dies. And when Betty dies, Martha gets $100,000. So the question is here. When Martha receives $100,000, is it an inflow included in gross income? So let's go ahead and let's now take a look at our table of contents and see if there's anything that can help us out. Okay, so we know we're looking for individuals, so we're looking at subchapter B, and we know it's an inflow, so we need to focus on specifically our areas that we go to for income tax. For income inclusion. My apologies for income inclusion. So let's go ahead and look at subchapter B and part 1 and all that good stuff. We can go ahead and skip all the way down to subchapter B. And just like we've done in a lot of other problems and a lot of other discussion, many videos, right, we start with section 61. So we're going to obviously go to section 61. And it's very likely that's going to apply. And the reason why, giving you a heads up, if you want to stop the video and look at section 61, you take a look. But one of the examples provided in section 61, right, in that list, that non-exhaustive list, is life insurance. If you receive life insurance, that's considered gross income. And remember, if we have gross income, the next step is then to go to part 3. In part 3, certain death benefits. And we saw section 101 earlier, and issues dealing with section 101, right? Dealing with life insurance and on someone's death. Well, section 101, we have certain death benefits, so we need to go there. And there's other, those are the main ones. You might continue to look, but of course, those are the main code sections, so we will go there. So let's start with section 61, then go to 101. If we still don't get an answer, we'll continue and look at other things. All right, section 61. So gross income defined. We've seen this one now. At this point, you're becoming pretty much an expert, right? Except as otherwise provided in this subtitle, gross income includes all income from whatever source derived, including but not limited to, and it gives a list. One of the items listed, income from life insurance and endowment contracts. All right, so actually, so that looks like that's what that is, right? It's and this is where ignorance is kind of bliss. I'm not saying that you are ignorant. I'm just saying that if you don't really know much about the income tax law, then this could actually have helped you, okay? Because this is actually dealing with the income on the life insurance and endowment contracts. It's not dealing with the proceeds from the life insurance or endowment contracts themselves. It's dealing with the income on it, as if, you were invested and get income like interest income or dividend income because you invested the proceeds. That's actually what it's referring to. But use that to your benefit. If you thought, hey, income from life insurance endowment contracts, section 61, hey, I got section 61, let's move on to part 3, you're still good. Because even if you don't do that, if you apply Glenshaw Glass in the 3-part test, right, accession to wealth, keep saying excession 2. My apologies. Right? I'm just so excited. I love this stuff. Excession of wealth, which means your net worth goes up. Realization. And D and C, which is dominion control. All three are met. Net worth's gone up, right? Because you get $100,000. Martha has $100,000. No liabilities. Realization. Okay? Realization, it's separate from the life insurance contract that secured it. Dominion control, she can do whatever she wants. She wants to take $100,000 and purchase a expensive car or put it into some investments, whatever she wants to do. Dominion control, she got all three. We have gross income. So whether you got it here or you got it here in Glenshaw Glass, either way, guess what? You're right. It's section 61 gross income. So now we go to part 3, and we got to look specifically at 101, which is the code section that we brought up potentially if we met section 61. So let's go ahead and look at section 101. All right, section 101. We've got section 101, certain death benefits, proceeds of life insurance contracts payable by reason of death. So general rule, except as otherwise provided in paragraphs 2, 3, subsection D, subsection F, and subsection J, gross income does not include amounts received under a life insurance contract if such amounts are paid by reason of death of the insured. So it looks like so far we've got exclusion, right? Because we know it's the general rule. We saw that earlier in the video, okay? But we should also consider the exceptions. Even if you think the general rule is going to apply, consider the exceptions. So let's look at paragraph 2, transfer for valuable consideration. If in the case of a transfer of valuable consideration by assignment or otherwise, that's something we did. Right? Remember on our timeline, we had the transfer where Betty transferred, she owed $5,000 to Martha, and she transferred the life insurance that she had that was worth $5,000, the surrender value, to Martha. So that is technically a transfer of valuable consideration if you continue reading the rules, by assignment or otherwise, of a life insurance contract or any interest therein. The amount excluded from gross income by paragraph 1 shall not exceed the amount equal to the sum of the actual face value of such consideration and the premiums and other amounts subsequently paid by the transferee. And the preceding basis shall not apply if you got a corporation or if such contract therein has a basis in determining gain or loss in the transferee by reference to the contract therein, blah, 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 okay, or partnership. So these exceptions do not apply, these exceptions to the exceptions. So we've got an exception to the general rule, which means, so this is the exception to general rule, which means we do have to include, but we do get to exclude a portion. And then these two things, A and B, are the exceptions to the exception, right? This is to show you that tax law, there is exceptions to the exception, and that would be exclude. Goes back to the general rule, but we don't meet those, unfortunately. We actually do not meet those. We're not a corporation, and we do not have A. So if you read more, you would find, or if you read more of in the code section, and please take your time and read, you would see that this would apply. Transfer valuable consideration, because that's exactly what she did. She assigned it before her death, and that makes it. And then this is defined later. For the sake of time, you want to go ahead and read that later on. It's defined below, and you'll find that, okay? It's defined later on, okay? So that means that this rule applies. So the exception applies. She only gets to exclude the portion that of the actual value and any premiums paid. So that's going to be the $5,000 value, surrender value at the date, and the $15,000 of premiums. So she only gets to exclude $20,000 of the $100,000 she received. That's the answer. That's the answer, okay? And a lot of times with some of these exclusion rules, there are special things where, hey, it's a partial income recording or whatever. And the answer you would cite is you would say 101 A2 as the answer, okay? And that's really everything, okay? That's really the end of that question. All right, so I hope you've enjoyed this video. Please go over this as many times as you need. Take as long as you need in these problems. Stop the video and go and read. Whenever I suggest you should stop the video. And again, please watch those other videos if you watch them, but there's something you're missing, because again, I put a lot of emphasis on those themes and those top 100 code sections to help you in the structure as well. I hope you've enjoyed this one. Again, This is part of a 3-part series. Do not rely on this Internal Revenue Code for purposes of substantive law or making tax decisions. It's meant to be a learning exercise, and I'll see you in my next video.